Good morning and welcome. I'm David Wessel. I'm director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings. Our mission is to improve the quality of fiscal and monetary policy and public understanding of it. We do this in a number of ways. I want to make a plug for a little computer game we've built on the federal budget problem in the United States called fiscalship.org. And I have a feeling that even though this is a conversation today about monetary policy, that we'll at some point find ourselves wandering into why are the fiscal policymakers putting so much pressure on the monetary policymakers. It really is an extraordinary moment in history, a time when we are consulting texts like Irving Fisher and John Maynard Keynes' Debt Deflation and Liquidity Traps, texts written before World War II to make sense of our early 21st century economic issues. Our topic today, of course, is negative rates, lessons learned so far. According to Fitch, there are now $10 trillion worth of global sovereign debts trading at negative yields, really an extraordinary number. The Wall Street Journal had a story a few months ago about a family in Denmark, Hans Peter Christensen, who had a mortgage and was getting 248 Danish kroner, about 38 US dollars, from the bank because he had a negative interest rate mortgage. Now, the negative rate was 0.0562%. If you read well into the story, you discover somehow the bank had managed to charge fees, so he was actually still a net plus. But still, it's pretty much a remarkable thing and something that most of us never thought we'd see. So today we're going to ask a few questions. Do negative rates work? How do they work? Are negative rates an option for the U.S.? What is the role of fiscal policy at a time when interest rates are very low? In fact, is the problem not that negative rates, but is this a symptom of a bigger problem and a world economy with an excess of savings and a dearth of investment that has pushed equilibrium rates low? And we're going to start this morning by talking about Europe. And I think during the day, Japan will come up, but we don't have anybody from Japan with us today. The plan is that we have two presentations and two discussants, and then all the presenters and the discussants will come up here and we'll have a conversation. Then we'll have a coffee break, and then we'll have another set of presentations. So our opening presentation is by Sina Krogstrup, who's from the Swiss National Bank, visiting here. And she'll be followed by Seth Carpenter, now at Rocos Capital Management, but formerly at the Fed and the Treasury, who will respond. And then we'll turn to Jean-Pierre Dantin, who is now at the Paris School of Economics, although from talking to him this morning, he seems to spend most of his life in airplanes. He's formerly at the Swiss National Bank, which of course is one of the big economies that has negative rates. And he'll be followed by Jamie McAndrews, now at the New York Fed. So let's get started. Sina, do you want to come up here? I should mention this is being webcast. This is on the record. All the slides are already on our website, and enjoy yourself.
There. Took time. So thank you very much, David, for inviting me to talk at this very timely and important event on negative interest rates. I first have to do a disclaimer that the views that I express here today are my own, are solely my own, and not those of the Swiss National Bank, not necessarily at least. So I get to open up this conference, and what I want to do is to give you all a broad introduction to the topic. I'll do that through raising challenges, raising unanswered questions, giving you background. And I'm going to do that based on the Geneva report. This is the forthcoming Geneva report. It's not out yet. I am co-authoring it this year with Lawrence Ball, Patrick Honohand, Joe Gagnon, and Thorsten Slück, who's also here today. So Let me start. So what I'm going to do is first give you an overview of the background. Why is it that we are talking about negative interest rates in the first place? That, of course, has to do with the fact that we are much more frequently constrained by the zero bound or the lower bound on negative interest rates and how that constrains monetary policy. I'll then turn to the experiences with negative interest rates in 5 countries, and I'm going to finish up with some of what I think are the main challenges and unanswered questions when it comes to using negative interest rate as a monetary policy tool. Okay, so starting with the background, it was previously considered really largely a theoretical curiosity that nominal interest rates would turn so low that it would constrain monetary policy options to respond to negative shocks to the economy. And that's clearly no longer the case. Nominal interest rates have come down substantially also in normal times. Nominal interest rates, as I have put up here, are equal to real interest rates plus inflation expectations according to a Fisher-type equation. And both of these components have come down substantially in the recent decades. Neutral real interest rates have fallen. There has been a secular downward trend since the 80s for many reasons that are being hotly debated. And inflation expectations have come down with actual inflation since the disinflationary policies of the 80s and since the widespread introduction of inflation targeting in the 90s. So both of these factors have resulted in nominal interest rates being much lower and much closer to their lower bound in normal times. And that has constrained monetary policy from reacting to strong shocks. So the table that I have up here is supposed to illustrate how this frequency of the constraint of the lower bound has increased in the past decades. So this is a table with annual average policy rates in 9 countries. And you don't have to be able to see the numbers. That's why I put colors in. So we have these policy rates from 1980 and up to 2015. And all the cells that are yellow are policy rates that are on average below 3%. Cells that are pink are average policy rates that are below 2%. And cells that are red are average policy rates that are at or below 1%. So as you can see, there was the lower bound constraint on monetary policy basically was not there in the 80s. And if we go further back, we would find the same. We did not have a constraint on monetary policy from these problems. That changed in the mid-90s. So the middle of the table here is more or less the mid-90s. There we had the first incidences, the constraint of the lower bound. The prime example is Japan. Arguably more countries became constrained or getting close to becoming constrained on monetary policy in the early 2000s, notably the US in 2001 that reduced the federal funds rate to 1% in the very mild recession of 2001. That's the lower red dot down here. And clearly since 2008, the lower bound constraint on monetary policy has been the norm and rather than the exception. And there's no reason to think that this is just a feature of the current recession or aftermath of recession. In fact, if real interest rates are going to continue their downward trend in the future, we might see a much more frequent incidence of the lower bound constraint. So this is an important problem. In the Geneva report, we estimate a very simple model for the US in order to assess the cost of this problem. We assume in this model that the neutral real interest rate is 1% and that inflation expectations are 2%. And what we find is that when we have a model characterized, an economy characterized by this model, the nominal interest rate will hit 0 very often, every time the unemployment rate exceeds the NAIRU by 1.1 percentage point. And if we go back in time with US recessions, we find that that was the case in 7 out of the 8 last recessions in the US. And that includes quite mild recessions, meaning that going forward, if we have similar recessions, even in the mild recessions, all else equal, monetary policy in the US is likely to hit the lower bound, according to this model. We have tried with different models and find very similar results. We also estimate a counterfactual for the severe recession in 2008, and that's what I have on the charts here. So we have a counterfactual where we assume that there's no lower bound on policy rates. And the upper panel in this figure shows the federal funds rate from 2008 onwards. And the red dashed line is the actual realization of the federal funds rate. And the blue line is the counterfactual. So we find that optimally, the federal funds rate should have been reduced to -6% in 2009, according to this model. And if it had been possible, policy rates could have returned to positive territory already in 2011. The mid panel is the unemployment gap, and the lower panel is the inflation rate, both with actual and counterfactual simulated paths. And they both will show you that economic performance could have been quite a lot better had there been no lower bound constraining monetary policy. So this obviously has a lot of implications, and not just for monetary policy. As David just mentioned, there are implications for how to use fiscal policy. What should be the right mix between monetary and fiscal? Should we have structural policies? In the Geneva report, we focus squarely on what central banks can do. So we take all other policies as given and not to be influenced by central banks. Given those, what can central banks do when they meet this lower bound constraint and need to loosen monetary policy in response to shocks? So we consider negative interest rates that we're considering today as well. We consider QE, we consider forward guidance. We argue that these tools are useful, they have advantages and drawbacks, and that those advantages and drawbacks differ across countries. And that there are limits that imply that probably we should consider other policies as well, that policies that prevent the lower bound from happening in the first place. And we notably consider raising inflation targets in the report. I will focus in the rest of my remarks now on negative interest rates and what we have learned so far. So negative interest rates is a way to further loosen monetary policy once nominal rates have hit zero. And 5 countries so far have gone down that route. Denmark's National Bank went there in 2012 as the first country. ECB, the Swiss National Bank, Sweden's Riksbank, followed, and the latest country to have gone into negative is the Bank of Japan. So this offers a nice panel of countries that both have time variation and cross-country variation to assess some initial lessons on how negative interest rates might be useful for loosening monetary policy. So do they work, is the first question. Does transmission work? So here, there are many facets to that question. So here I start with noting that when we look at these experiences, transmission to market rates, from money market rates, capital market rates, has worked very well. In fact, there are some examples of longer-term capital market rates coming down even more than they would in normal times, suggesting that there are some expectational effects. And I know that one of our presenters later today will talk about such issues. We also find that transmission to exchange rates has worked very well. We base that on the experiences of Japan and Sweden and the reaction of capital flows to negative interest rates in Denmark. And an important point to make here is that this is exactly as monetary policy would work in normal times. So this is not, just because the exchange rate channel is working very well here, it doesn't mean that negative interest rate is an exchange rate measure. No more than monetary policy is an exchange rate measure in normal times. It is exactly the same. Where transmission changes is with banks. Deposit rates in banks, there has been some transmission. It doesn't mean that there's no transmission. There is some transmission to bank rates. So there has been transmission to interbank rates, to institutional rates, to some corporate deposits. Where there's no transmission is to retail deposits. So this raises a host of questions as to why that is, what is this friction about, might it change in the future? Lending rates, there is more cross-country variation. So in some countries, lending rates have come down, the euro area, Denmark and Sweden, for instance. In Switzerland, lending rates did not come down when they introduced negative interest rates. And in fact, some long-term mortgage rates increased. So there is a lot of cross-country variation in how bank lending rates are reacting to negative interest rates. That raises a host of questions as well that I'm sure we will talk more about today. Just because negative interest rates transmit to broader asset markets and interest rates, does it mean that it's transmitting to the real economy? So this is a question that's being often debated. And I think the first point to make is that in theory, there is no reason why it wouldn't. This is really monetary policy as usual. It's a cut in the nominal interest rate that leads to a cut in or a reduction in real interest rates and a reduction in international interest differentials. And it is those relative prices that should matter for investment, savings decisions, consumption decisions, and not the nominal rate per se. Now, there are some that argue that when rates go into nominal negative, behavior changes. So this reaction to interest rates changes. In fact, it can even reverse so that lower interest rates will lead to higher savings instead of lower savings. That could be if there's widespread money illusion and if people have nominal long-term savings targets that they have to meet. But that is more or less always the case also for monetary policy in normal times. And it could also be that nominal illusion or money illusion could lead to the opposite, that we perceive of a much stronger cut in the interest rate, and therefore it boosts spending through substitution effects. So that would be the normal case with monetary policy. In the end, it's an empirical question, and we don't really have evidence so far. We always have the problem that we don't have a counterfactual when we want to assess the effects of monetary policy. There are some encouraging initial signs that credit growth seems to be picking up generally in countries that have introduced negative interest rates. A very important question that I also come back to in my last slide is, where is the lower bound? So using negative interest rates is obviously a way to get around the lower bound constraint on monetary policy. Now, how much monetary policy firepower do negative interest rates currently offer? That depends on where this lower bound is. The lower bound is defined as the point at which we have a big scale switch into storage of cash, zero yielding cash. And we haven't seen any signs in the negative interest rate countries so far that that is taking place on a large scale. Now, that point obviously depends on the assessment of the cost of storing cash, and there are a number of studies out there that look at that. They seem to, the variable cost of storing cash seem to be very low. There's some anecdotal evidence that they are very low. There are some studies that go all the way up to 50 basis points, but that's really the highest number that I've seen, and it's more likely to be much lower than that. And the fact that we still haven't seen a shift into cash at low variable cost of cash storage implies that there are some big fixed costs out there. These big fixed costs of setting up the storage capacity, they're very difficult to assess. They have to be high in order to justify that it's not taking place on a large scale yet. And that raises the question of whether they are high enough to justify going in even further into negative territory. That's another open question. There have been a lot of concerns about the negative side effects of using negative interest rates. And I've grouped these into 4 categories. There are concerns that they adversely affect bank profitability. That could in turn negatively affect the transmission mechanism, could also negatively affect financial stability. There are concerns that the money market mutual fund industry will be destabilized by these measures. There are also concerns that the insurance and pension fund business models will not survive negative interest rates. And then there are concerns about financial market infrastructures and markets, whether they can technically deal with a reversal in the streams of interest payments. In the Geneva report, we look at all this and we find that, yes, some of these concerns are really worth keeping an eye on, but the experience so far seems to indicate that such concerns have been overstated, and they shouldn't be reasons for not using negative interest rates if a central bank needs to further accommodate in response to a shock. This can change if interest rates remain negative for a longer time period. These costs can, of course, change. That brings me to my final slide on what I see as some of the big challenges and unanswered questions for central banks that need to use negative nominal interest rates in order to loosen in response to shocks. And the first one is, as I already mentioned, is the lower bound on interest rate. So in order to counteract this lower bound on constraint on monetary policy, there has to be substantial additional firepower below zero. And the question is, how much firepower do we really have? Are we already at the limit, or can we go further down? This is an unanswered question. There could be variation across countries. That means that if some countries can't go quite far down, it doesn't necessarily mean that that could happen in other countries. That's something that needs to be considered. Most importantly, will it be enough, or should countries consider other policy measures in order to sufficiently be able to loosen monetary policy in response to shocks? The second point I have here is that if it's so important that this lower bound, can we take measures to push down further the lower bound from where it is now? And I'm going to leave that question here because I know that several of the presenters later will address that. So I'm sure we're going to have a lot of discussion. That's a very interesting topic. The final point, I think, is one of the most important ones. And that is that there is a big challenge in the fact that the public does not necessarily understand or accept the use of negative interest rates. This goes back to the problem of both money illusion, that people don't really understand the difference between real and nominal interest rates. And this poses a big challenge for central banks when they need to use nominal negative interest rates to loosen monetary policy. I think this raises questions both for how to communicate why such a measure is really important and needed, and also to communicate and educate better what is the difference between real and nominal rates, and what do these measures imply for the lifetime real incomes and savings of ordinary citizens. So I will stop there.
Excellent. Thank you very much, David Wessel. Thank you for including me. Thanks to the Hutchins Center and to Brookings. So I'm going to have a brief discussion focusing on some of what Signe just spoke about. Signe gave a good overview of a lot of the different topics we're going to be discussing here, and I, in some sense, get to give an overview of an overview. And so the way that I wanted to do that is to just lay out, among the whole set of different issues that Signe brought up, maybe three broad questions to try to frame, at least from my perspective, some of what are the interesting questions we'll be talking about today. First, and in a very sort of general and quasi-philosophical way, is the debate that people are having about negative interest rates. There are lots of people who are strongly opposed to negative interest rates, thinking that they're have adverse effects on the economy and they don't do any good. Is the criticism about negative interest rates truly about negative interest rates per se, or is it somehow a confounding of the debate about monetary policy more generally? So we're in an era where it seems as if monetary policy perhaps is less powerful than it had been in the past. Is, in some sense, negative interest rates as a particular version of monetary policy getting tarred with a more general criticism for monetary policy? Second, is there enough theoretical understanding of the transmission mechanism to assess the criticism of negative rates? And I'm going to be more specific about this on another slide. But it does seem to be the case that we are in uncharted waters, that this is, say, 10 years ago, 15 years ago, not the sort of topic that lots of economics textbooks would have treated. And as a result, when we're trying to think about what are the costs and benefits of negative interest rates, I do wonder if we have thought through carefully enough how the transmission mechanism works. And lastly, to show my nationalistic, jingoistic bias, I'm going to ask if the U.S. is a different case and how important market structure matters. I think it seems almost vacuously true that market structure matters for the transmission of monetary policy. It is interesting of the large economies that we've been talking about that the United States did not, in fact, have negative interest rates. And indeed, the Federal Reserve did not even take its interest on reserves rate down to zero. It stopped in positive territory. And so I think that's another area to think about. What's so special about the U.S.? So for the first question, again, I believe this sort of questions within the question to try to frame what I think of as some of the important issues. So how much of the debate about negative interest rates is just about the effectiveness of monetary policy? Signe alluded to this. If you were to plot nominal interest rates over a multi-decade time period, and if you were to do that in nominal rates or in real rates, you see this long secular decline. It seems clear if you look at estimates of the neutral interest rate that the neutral interest rate is likely much lower than it had been historically. And so as a result, monetary policy of any kind, just adjusting up or down the short-term interest rate, might be less effective if you look at it for how much a given setting of the funds rate would be in the context of the United States. Is a 1% federal funds rate, nominal federal funds rate, as stimulative now as it was before? Well, presumably if the neutral rate is lower, the answer has to be no. But again, if that's the case, if the neutral rate for interest is lower than it had been in the past, then any given setting of monetary policy that might have been accommodative in the past is less accommodative now than it was before. That's not necessarily a criticism that negative interest rates aren't effective as monetary policy tools. It's just a general statement that monetary policy or interest rate policy is less effective than before. Relatedly, one theoretical limit to monetary policy in general is about intertemporal substitution. Part of at least one version of the theory of why monetary policy might work is that it could induce some intertemporal shifting of spending. And yet we've seen in the U.S. and other large economies extraordinarily low interest rates for an extraordinarily long period of time, and perhaps due to people's ability to make computations out through time or discounting, maybe there's a limit to how much intertemporal substitution can take place. But again, that would be a criticism of monetary policy and the ability of low interest rates more generally to stimulate an economy after a large and persistent shock, and not so much about negative interest rates. To take the same question and turn it on its head a little bit, well, what would it mean for everyone to uniformly say that negative interest rates are a successful tool or an effective tool? I think it's too easy to say that negative interest rates aren't effective, because if you look at the economies that have introduced negative interest rates, we don't see a large increase already in aggregate demand. We don't see large increases in inflationary expectations, because again, that would be leveling the criticism against all policy in those countries. Cigna notes that money market rates in the countries that have engaged in negative interest rates have reacted in much the same way that money market rates work with positive interest rates. She made some reference to the same thing with exchange rates. So is it possible then that negative interest rates are just as effective as any other sort of traditional monetary policy using interest rates? It is simply that monetary policy itself has become less effective. I think that's the sort of question we need to delve into, because it's a little bit too easy to criticize negative interest rates on their own because they're unfamiliar. So the second set of questioning that I wanted to bring about is just our theoretical understanding, and a lot of what is discussed is the effect on banks. A lot of discussion, has been written about the effect of negative interest rates on banks' net interest margin. And so I think it's worth asking, have banks actually been harmed that much? Or more importantly, over the medium term, is it likely that they are going to have been harmed a great deal? Or is it possible that, possibly through better central bank communication, possibly just through experience, that banks and the public were going to rethink how banks work and what is acceptable in terms of charging interest to their customers? The simplest example I can think of is since time immemorial, we have had checking accounts in the United States that pay zero interest explicitly and yet have fees attached to them. So in effect, that's a negative interest rate, something that has happened for decades upon decades in the United States, and no one has ever thought that somehow this was a challenge to the normal world order for banks. So we have had negative interest rates, and people got used to it over time. Similarly, in the face of regulation and regulatory costs, we've seen large banks start to shed non-operating deposits because they were too costly. So there are changes that happen to the environment, and banks, being profit-maximizing institutions, learn how to adapt, and the customers presumably learn how to adapt as well. There's more theory that needs to be explained from my perspective on the differential reactions of banks in different areas to negative interest rates. So Cigna pointed out that there were banks in some countries that in fact raised the rates that they're charging, especially on mortgages, in response to negative interest rates. It's a bit puzzling, and so we'd want to think through how much this relates specifically to negative interest rates and what's going on there. Because if you thought about a simple competitive model, a single bank who raised the rates that it charged its customers would presumably, at least at the margin, lose some of those customers to another bank. And so on their balance sheet, the loan, the higher yielding asset compared to the negative yielding reserves at the central bank, decline And so that choice should actually be making their net interest margin much worse because they're shedding their higher yielding assets. So it's a bit funny. You need some sort of much more complicated than a simple competitive model of banking to explain that effect. And finally, Ben Bernanke is frequently cited as having said that large-scale asset purchases work well in practice, but less so in theory. And I think here's another case where we want to think about that type of conundrum. Historically, people have pointed to a flat yield curve as being very bad for banks' net interest margins, and a steep yield curve as being better. And yet, there tends to be a fair bit more of a criticism that negative interest rates should be bad for banks' net interest margin and not so much additional QE or large-scale asset purchases. Well, going to negative interest rates is cutting the front end of the curve. That should be all else equal steepening the curve, and that should be better for banks' net interest margin. And more asset purchases should be flattening the curve, which should be worse for banks' net interest margin. So somehow the criticisms leveled against negative interest rates and their effect on net interest margins seems to be not particularly carefully parsed out vis-a-vis what the effect of large-scale asset purchases are. And then finally, the U.S. Is the U.S. different? How much does the market structure matter? The U.S., I think, as most people realize, is much less bank-centric than a lot of other developed economies, much more capital market-centric. And because so many of the criticisms about negative interest rates have been leveled against the effect it has on the banking system, it is, at least to me, a bit ironic then that the one country that has not done negative interest rates is the least bank-centric economy in the debate. Signa pointed out how well money markets have taken to negative interest rates, and all of the debate in the U.S. about negative, even going to zero, let alone going to negative interest rates, was about the potential functioning of money markets. So again, perhaps there's a bit of an irony there. The rejoinder, of course, is that money markets play a much larger role in the United States in terms of capital allocation than they do in other economies. So maybe then the role of money funds does make a differential. But it's not entirely clear then, though, to me, if the criticism of negative interest rates is about its effect on banks, that negative interest rates should be less well suited to the United States than to other countries. And finally, I think what needs to be understood is credit easing, because negative interest rates are never executed on their own. They're always part of a larger package of central bank initiatives. And if the United States, being less bank-centric, matters, then perhaps the interaction is not just negative interest rates in other countries that should be compared to what's going on in the United States. It's negative interest rates in the context of these credit easing programs through a bank-centric model. Again, I think these sorts of questions about the structure are important and hard to answer. Thanks.
Thank you, Seth and Sina. So I just want to explain that we're going to now we're going to look at three countries: Switzerland first, Denmark next, and then the European Central Bank. So to start us off, Jean-Pierre Dantin, who's a former vice president of the Swiss National Bank and now a professor of finance and economics at the Paris School of Economics, will talk about Switzerland. Jamie McAndrews, who's the research director at the New York Fed, will then respond, and then we'll have a coffee break. So Jean-Pierre.
Okay, where will I see this? It? It? No, it's not it. See the sign for. Okay. So, sorry, I'm a Mac person, so I'm so anyway, thank you for the invitation. It's a pleasure to be here. I'm going to be zooming in on the Swiss experience and trying to be as complementary as I can from what Signe said. So I'll be very focused here. I have a very simple message, and let me directly go to it. First message is that negative interest rates are not popular. And the fact that they are not popular, certainly if we come from Switzerland, that means that you've got a problem. I think what we can conclude is that we cannot go much lower. We are basically at the effective lower bound. Take it or leave it a few basis points. So in order to go much lower, we need radical measures that have been proposed by people in this room, and I'll mention them in a moment. And these radical measures simply are not democratically enforceable today. That would be the Swiss lesson. First one. Second one, negative policy rate, and here I'm just summarizing what Signe has been saying, are transmitted to market rates, but mostly not to bank rates. And I say mostly not, I'll detail it a bit, but for Switzerland it's almost not at all. Retail deposit in particular have not been affected, but bank lending rate have been only minimally affected. Now, that could look like bad news. I will take it as a rather good news because I will consider that an intermediate constellation, such as this one, that is where the general public is not directly affected, but of course, as a counterpart, there is an asymmetrical propagation, could constitute an avenue for a further push into negative rates, into negative territory. Although, of course, with negatives of this alternative avenue, which is that this would be a limited transmission mechanism. And so my question was, do we have, is the interest rate unbound? Are we freed from the zero lower bound? I would say no, not soon at least, for central bank in search of a monetary stimulus at the zero lower bound. But yes, in a limited sense, for small open economies like Switzerland, in search of an interest rate differential. And tongue-in-cheek, that is particularly the case for a safe haven currency. Now, I will logically talk about how low can we go and whether we have asymmetrical transmission. Just, again, detail a little bit some of the lessons that we have taken. As an introduction, I would like to make 3 points. First of all, negative rates, what for? What is the motivation? And I think it's important here, and it's important for my message, which is dichotomous, to see that there are two reasons to motivation, to reason why negative rates have been introduced. On the one hand, small open economies, and I will take specifically Denmark and Switzerland, have introduced negative rates for exchange rate consideration. Okay, they wanted to protect an exchange rate peg in the case of Denmark. In the case of Switzerland, that was the initial motivation. Later on, it was to reintroduce an interest rate differential and moderate the forecasted appreciation of the Swiss franc following the drop of the minimum exchange rate. For larger economies like Japan and the euro area, then the idea is more having a classical monetary stimulus. This difference is important, is particular relative to my conclusion. In the case of Switzerland, I can illustrate the fact that in order to have a reasonable, I would say, exchange rate, when you have a safe haven currency, you need to have a negative interest rate differential. Your investment in Swiss franc come with sort of an insurance against tail risk. That insurance has to have a cost, and the cost is lower than lower interest rate. Here you see in particular very striking the gray 3 months LIBOR in the euro area since 2000. In blue, the 3 months LIBOR in Switzerland since 2000. You've got this, what we call in Switzerland, an interest rate bonus, which is a bonus in good time, but it's, of course, that's a counterpart to a malus in bad time. First, that was my first observation. Second observation, 5 countries have introduced negative rates. As Signe has mentioned, retail depositors have not been affected. No negative rate on retail deposit. Why? Well, I would argue that the reason is that negative rates are not popular, and I will detail that in a moment. They are not popular. As a result, banks are afraid of losing their clients permanently, in particular losing their clients, which are the good clients, the ones on which they make money because they bring in cash for free in normal times. And so they are going to manage their client relationship. And they can do so, that's the second element of it, because central banks, the Swiss National Bank in particular, has introduced very large exemption thresholds so that the bank can afford not to transmit this negative rate to their funding side. Third observation, if I go back here, my third observation, it's an unpopular measure. Okay, why is it unpopular? I cannot go through all the argument here, but I would say three things. First of all, people do not understand it. That's what Sinéad has mentioned. They are counterintuitive, they are unnatural, they are against nature. And you say, we economists come and say, but you have had it all along, it was negative real rates. No, that's not enough. That simply doesn't work. And that's one problem. Second problem, that comes at the sequence, at the end, or not maybe the end, hopefully the end, of a long period of very low rates, which is frustrating everyone. And this is a cherry on the cake. People are complaining about very low rates, and here we come with negative rates. This is really terrible, and people are complaining in particular the pension fund lobby have been very vocal, and everybody has a pension. So indirectly, everybody is affected and feel like is in some sense cheated. The third thing, which is a bit more, maybe more idiosyncratic, is that our exemption policy, and here I talk about the Swiss National Bank, has led to very unequal repartition of the burden. This is explained in my next slide, which is not, especially the right-hand side here. You see the Swiss National Bank has increased liquidity massively before moving to negative interest rate, buying euros to protect the floor. But this excess increases liquidity, which led to a balance sheet of almost 100%, we are now at 100% of GDP, has been very unequally shared. In blue, you have the big banks. In red, you have the cantonal banks. And in yellow, you have all the other Swiss banks. All the other Swiss banks are mostly the wealth managers. These wealth managers have, in a sense, promoted cash in Swiss francs as a specific asset class. They have attracted a lot of cash. They have huge cash holdings relative to their pre-crisis required reserves. And they have been hit, even though we have a 20 times reserve threshold, they have been hit massively. And they have been extremely active in protesting against the policy of the Swiss National Bank, with calls of unfairness, which the public love to hear. Today, anything that is unfair is lovable and is good for the discussion. And so this has been the situation. Okay, now let me say a few words about how low can we go. I would argue that we are there, that the effective lower bound is very close to minus 75 basis point. We have gone from 0 to minus 75. I don't think that means that we can go much lower. I don't fully agree with the diagnosis that there is a big fixed cost. I don't think there are big fixed costs. I would simply suggest that, yes, it may take some time to set up alternatives, cash hoarding, and in the case of Switzerland, we know we are an expensive country, so where others may say 50 basis points, we are maybe a bit higher. And we are a small country where moral suasion by the Swiss National Bank is more effective than elsewhere. But I think basically we are very close, a few basis points here, and very close to the effective lower bound. So my conclusion is that from that little argument is that if you're going to go lower, you want to be radical. You want to be radical, that is, you must abolish paper currency. That's the first proposal. Abolish paper currency, make cash hoarding impossible. Or you may introduce an exchange rate between paper currency and electronic money to force negative rates on paper currency, as has been proposed and will be discussed, to make cash hoarding ineffective. Okay. I will describe a little third way where we could say we will make wholesale cash hoarding ineffective, and we will make retail cash hoarding pointless. Okay, I will describe that in a moment. Before I do that, I would like to suggest that simply abolishing cash or introducing an exchange rate between paper currency and electronic money is not within reach in democratic society, taking Switzerland as an example. Abolishing cash, I would say not in the near future if people have a voice. And here I talk about revealed preference first. Cash is not on the decline, except in Sweden. Here you have in red the ECB, in yellow the Swiss National Bank, the Switzerland, in whatever it is, Denmark in purple. And it's only Sweden where we have a decrease in cash holdings. It is people continue using cash despite what we think and what we describe. More even, I think, revealing, if you take Switzerland, which may well be representative of the German type of countries. I would bet that Austria and Germany would be the same. But if you take, look here, you have the ratio of paper currency to GDP since 1907. And you see that there is a big peak, this doesn't work, I suppose, big peak at during the Second World War. And following the Second World War, there was a big decrease in cash, and you can imagine why it was, a big decrease in cash relative to GDP, but that has stopped in 1990. Since 1990, there has been no more economizing of cash because of credit cards and advance in technology. Flat. That's a long period, and given the very long evolution. And you see, of course, since the crisis, there has been a big increase in cash demand. Now, what I explain that behind that, what you have is the fact that people still are using cash for payments. In Switzerland, it's not rare to see people coming out with a 1,000 Swiss franc bill. It is not rare. They're using it for transaction. They are using it, and that's clearly what we see since 2007, for precautionary savings, precautionary demand for money. In fact, here you have the demand for 1,000 Swiss franc bill, which is, I know, on front news lately. You see, it's starting to really boom since 2008, and we have daily data, so I can tell you it started right after Lehman Brothers. There's not a big increase in crime in Switzerland right after Lehman Brothers. You know? It is really due to the fact that people want to have something safe to hold on when times are uncertain and the banking system is under suspicion. And what they hold on is 1,000 Swiss franc bill. They probably hold on gold as well, but for a Swiss, a 1,000 Swiss franc bill is much better and lighter than gold. So my conclusion from this is that in direct democracy, there is no way we can abolish cash in the near future, and that route is prevented. No. Elsewhere, of course, you may say the technocrats can prevail. I would beware of that. I think it would be very, very dangerous. The second possibility would be to have an exchange rate with electronic money. It's clearly less radical. That was the goal of it. But it will require legal changes anywhere, in Switzerland at least. So there will be a public discussion. And we know why we would want to introduce that exchange rate. It's to permit lower negative rates. And people hate these lower negative rates. So the discussion is most likely to conclude that with a no vote, we don't want that kind of development. I don't think at the moment, I think the unpopularity of negative rate means that it is not an avenue that is feasible, again, thinking about a democratically supported measure. Is there a third way, or is it the end of it? As I suggested in my introduction, I think there is a third way, but it's not palatable for everyone. The third way, in a sense, is to consolidate the current situation in Switzerland. What would that be? 3 steps. 1, spare the banks through large exemptions. Okay, so continue to make sure that the banks are hit by negative rates at the margin, which affect market rates, but they are not hit on the massive of their reserve. Second, build on the unpopularity of negative rate to ensure that the general public is not affected. That is, build on the fact that bank deposit rates are set to 0, and in that case, there will be no cash hoarding incentive for the general public. And third, introduce a fee for abnormal cash withdrawals at the central bank, thus making wholesale cash hoarding unprofitable. We could use various mechanisms. I have no time to detail them. The point here, of course, is that you want to have a fee that simply prevent cash hoarding, so that fee will never be levied. It will simply make wholesale cash hoarding unprofitable. And in that case, it will be possible to impose significantly lower negative rates. Okay, No, the rest I can be very short because we have said what needs to be said. Of course, with the proposal that I make, we will comfort the asymmetrical transmission mechanism that we are observing, market rate versus bank rate. And that means that in terms of the impact on the real economy, the impact will be limited, but it might be sufficient for the purpose of some of the central banks. Here I have a few slides, basically to comfort simply the fact that, yes, market rates, here you have the Swiss bonds of the Confederation, have been falling on the spot immediately on the date of the announcement of the negative rates. So clear reaction of money rates, clear reaction of bond rates. What is more interested, including private borrowing, what's more interested is bank lending rate. Bank lending rate, here you see absolutely no pattern, no impact on bank lending, either here short-term or mortgages. The more interesting diagram line here is the green line. The green line are long-run mortgage, up to 10-year mortgages in Switzerland. You see on the date of the announcement of the negative interest rate, there was a start up actually on the date. If you did daily, there was a dip. It lasted a few days, and then the mortgage rate started to go up. And a couple of months later, they were at the same level as they were mid-December before we started even to talk about negative rates. How do we understand this? I think it's really this notion that the bank don't want to transmit this rate on the deposit side. So on the funding side, they are at zero. They would like as much as possible to protect their profitability by making sure that on the asset side, they also do not have to transmit the rate. And they've been able to do so by various mechanisms. One was that ahead of when they saw the negative rate coming a year or two before, they decided that the LIBOR plus mortgages would be built on LIBOR plus a margin or max of zero and LIBOR plus something. And so when the LIBOR becomes negative, the zero was the bond. And so there was no change legally and no contestable change on flexible variable rate mortgages. On long-run mortgages, it's clear that there has been a concerted effort by the bank to protect their margin. They could not get any help on the funding side. They should not be able to push it on the negative side. This may have been helped by the fact that the Swiss National Bank was suggesting that the situation was very risky, that the market was booming, that there was over-exuberance, and that banks should be prudent and conservative. So they might help consolidate an equilibrium around a policy to be less generous in terms of mortgages, but the result is there. Mortgages have not moved. Now, if you think that mortgages and basically lending to firms has not been affected, you of course have a very limited transmission mechanism on the real side of the economy. And that leads me on my last 30 seconds to simply my conclusion. Are interest rate on bond? The answer is no, but maybe. No, because because for big economic areas, going lower is not immediately feasible in my view, and the current circumstances or the proposal that the intermediate proposal that I make has not a real side impact, has not a real macroeconomic impact, but maybe for small open economies in search of a negative interest rate differential, where indeed it would be possible to go lower with limited ambition in terms of the transmission mechanism, but with a significant effect on market rate, including exchange rates.
Thank you. Thanks. Very happy to be here. Thank you, David, for the invitation. And I would like to say that the views I express are my own and don't necessarily reflect the views of the Federal Reserve Bank of New York or the Federal Reserve System. Jean-Pierre gave a wonderful presentation of a really excellent paper where he reviews the experience with negative rates in Switzerland. And it's really quite an interesting story. He points out a very strong downward move in the government yield curve. But at the same time, bank deposits are anchored at zero. And this is where I think Jean-Pierre points out his story differs a little bit from Signa's and Sess, where we have this very unusual policy mix, where we have market rates at one area, at one level, and then deposit rates at another level. That's distinct from the policy moves in positive interest rate territory. Interestingly, mortgage markups rose, and there was even some evidence of rising net interest margins at banks. And there's been no large surge of currency use. So the question is, how effective has this policy been? So importantly, the policy objective, as Jean-Pierre pointed out in Switzerland, and he ascribed this to Denmark as well, was to prevent the Swiss franc from appreciating. They had just lifted the floor on the Swiss franc, and they introduced the negative interest rates as a supportive measure to keep the Swiss franc from appreciating. And there has been a very strong transmission into market rates, as he pointed out, into repo rates. But at the same time, the policy mix, as Seth pointed out, the policy is always a bundle of policies, and in this case, the bundle includes a very large exemption on bank reserves. 20 times the required reserves are exempt from this negative rate policy. And banks have generally refrained from imposing negative deposit rates on their depositors. So it seems that the effect of the negative rate policy on market rates is consistent with the policy objectives, and that's similar in Denmark. But if the goal is to more broadly affect aggregate demand via the portfolio balance channel, then the exemptions of large amounts of reserve balances may not be so supportive of that policy objective. So I think that's something to look for across the countries. I don't think we have the evidence to determine very easily. But the increase in longer-term mortgage rates and these other spreads, which Jean-Pierre points out in his paper, are very much, to me, a very cautionary sign about the effectiveness of negative policy rate in easing financial conditions broadly. While highly rated borrowers do seem to have experienced lower borrowing costs after negative rates were implemented, there was one little area in Jean-Pierre's slide where the borrowing rates for very highly rated borrowers actually dipped below zero. Mortgage rates and other bank rates moved up. And again, it appears that banks' net interest margins may have actually expanded. In Denmark, as well, longer-term mortgage rates, the rates on longer-term fixed-rate mortgage rates actually moved up with the negative rate policy. So that, again, makes me question how effective this has been as a policy to ease financial conditions, separate from the interest rate, from the exchange rate aspect of it. Now, Seth pointed out that that lowering short-term rates can steepen the yield curve, and that could be good for banks. Here we look at the slope of the yield curve with the Switzerland 10-year government bond, and the dashed line is the 10-year government bond minus the policy rate. And indeed, lowering imposing the negative interest rates did raise the slope of the yield curve. But if we instead look at the blue line, which is the 10-year government bond minus the 3-month sight deposit rate, the savings account rate at banks, there we see that the compression in yield. So if all a bank did was take deposits and invest in 10-year government bonds, it would be losing money. So the banks felt they had to do something to expand their ability to preserve their profits, as Jean-Pierre pointed out. This may have led them to actually raise mortgage and perhaps some other borrowing costs. Now, in that environment, you can get financial innovation. And Jean-Pierre talks about the Fondbriefe, these other institutions that fund themselves in the market rather than through deposits. And here is just a slide that my colleague Andreas Fuster, who's Swiss, was able to find for me that compares just two institutions, Credit Suisse and AXA Winterthur, that are examples of this sort of competitive effect taking place. We see at that very big dip, that's when the negative rate policy went into effect, and we see the mortgage rates for Credit Suisse in green and the mortgage rates for AXA Winterthur in dark gray, and you can see that the spread between those rates expanded then. Now, these companies have a very low market share in Switzerland. I don't know if this is practically a large competitive move on their part, but nonetheless, it's a sort of financial innovation that we can expect with policies like this. And here the area which can be exploited in this policy is the difference between the deposit rate and the market rate, which is the unusual aspect of the negative rates as they've been implemented especially in Denmark, Japan, and Switzerland, where there are large exemptions to the bank reserves. So again, I think that there are reasons to question how effective the Swiss experience with negative rates has been. As Jean-Pierre points out, we don't have the counterfactual, and as Seth pointed out, so we don't know. But the experience of wealth managers offering zero-rate deposits to foreign depositors is I think, a pretty significant limitation. Has this really affected the exchange rate? Because if these foreign depositors can still get zero through these wealth managers, that would seem to be countering the objective of the policy. So that's one question to ask. The transmission into bank deposit rates and lending markets, as we've talked about. And then a very interesting case that Jean-Pierre pointed out at the end of his talk is this contractual impediment that was put into place a year before the policy by the banks, looking forward, saying if we ever get negative rates, we darn sure don't want to give negative rates on our variable rate mortgages, so we'll say the mortgage, rather than being set at LIBOR plus a markup, is going to be set at 0 plus a markup, no matter what the LIBOR rate is, if it goes below 0. So that was a clever move on the part of the banks, not have to deal with that. And I'll talk this afternoon about why some of those things may be difficult to implement, why the particular design of mortgages has to be thought of very carefully if money is going to be moving to the borrower. And so we're left with the question, is exports been the main channel of transmission? So this is a question for Senya and Jean-Pierre. Has there been, what has been the effect of exports? That seems to be the one channel of transmission that would be open since domestic financial conditions don't appear to have eased significantly. What alternative policies might have been used, even granting the lifting of the exchange rate floor? So Switzerland is sitting there, and it lifts the exchange rate floor, and then they turn to negative rates. Could they have done anything else? Well, one other possible policy to think about, and this is just for discussion purposes, I'm not suggesting these, I'm just trying to think of what else could be done. One would be capital controls. So directly taxing the deposits of those foreign depositors. So that would be an alternative, and that would get around this competitive dilemma that those wealth managers are in that prevent the transmission of the negative rates to those large foreign depositors. Those seem to be the precise people that should be taxed in order to prevent this this appreciation to which the Swiss franc is prone at common interest rates. So if the interest rate is the same between Europe and Switzerland, between the Eurozone and Switzerland, the Swiss franc appreciates. So one could tax those types of deposits. Another alternative is the Swiss National Bank's interest rate target is generally understood to be from 0 to 2. It's less than the inflation target, excuse me. Yes, their inflation target is generally understood to be from 0 to 2, that they have a target of less than 2%, but people understand this to be 0 to 2%. The Swiss National Bank could change that, as the Bank of Japan did, and move it, let's say, to a range of from 1 to 2%, to make clear that very low rates of inflation are unwelcome. And they could emphasize this in communication and in other elements of the policy framework. So there's just some alternatives that might be worth thinking about. Thank you very much.
So why don't we bring all four of you up here and we'll briefly discuss, and then we can turn to questions. Okay, thank you all. I think I might want to start with Jamie's last point. Jean-Pierre, when the Swiss National Bank moved to negative interest rates, it seems to me, primarily aimed at the exchange rate. And if I understand what you said correctly, it worked.
Yeah.
It had an effect on the exchange rate.
Well, it's a million-dollar question because we don't have the counterfactual, but we know that it did restore an interest rate differential with the euro, and you would expect that's the one variable that we know seemed to be effective in exchange rate equations, and it did seem to work. At least the evolution has been the way predicted. There was a huge overreaction on 15th of January. Today we are at 1 franc 10 to the euro and almost 1 franc to the dollar almost, which is exactly the type of constellation that people would have said, if that's where we get at, things are okay. In fact, the Ministry of Finance exactly said that the day after the lifting of the floor. So it's really plausible and to argue that, yes, it has been working. The interest rate differential is not as large as it should be, as I've shown, if we wanted to have a properly valued exchange rate, and we have an overvalued exchange rate, but it has been much less overvalued. It has countered the overvaluation as was expected when we lifted the floor and introduced the...
And has that had the desired effect on exports?
And as a result, we knew that, of course, lifting the floor would mean that the Swiss franc was going to get stronger, and that would hurt export. Export have been hurt. The economy has been hurt. The forecast that we made on the day previously to the 14th of January, which on the basis on which we made the decision was that we would have a growth of 0.9% for the year instead of 2%. So we knew that there was going to be a cost, macroeconomic cost. And in fact, and that cost would last for 2 years. That was our assessment. And it has been so far totally vindicated. The rate of growth, the last estimate of the rate of growth 2015 for Switzerland was 0.9%. So, you know, there is a slowdown of the economy because the exchange rate is going to go too high, because we have limited margin of maneuvering at the lower bound rates. We cannot restore an interest rate differential as large as necessary, but we go some way and we get some impact.
Yeah, I just want to add to that. That is one of the reasons that it's hard to assess the impact of a negative interest rate. In Switzerland, in the case of Switzerland, it was introduced exactly at the same moment as another policy was introduced that led to a 10% appreciation of the exchange rate. And of course, that shock had a huge negative impact on the economy. The negative rate arguably pulled in the other direction, but it's very hard to separate those two effects. In fact, the net effect on real rates was almost constant, so we wouldn't expect a big boost from real rates from this negative interest rate drop, because inflation expectations fell strongly when we had this negative exchange rate drop.
Seth, what do you think of Jean-Pierre's argument on the politics of all this?
I think it's pretty astute, I have to say, going from a fairly non-political place like the Fed to when I was at Treasury, where there was always the sort of rigid analytics plus the political overlay. I was actually...
What does Elizabeth Warren think? Is that basically...
I was fairly well convinced by the argument. I mean, trying to force a pretty substantial, massive change in cultural norms through a democratic process is just very, very difficult. And Miles is going to be talking later about some of the pretty dramatic changes you could make to get rid of the zero lower bound. And it all works extraordinarily well in theory. I think getting people to understand the benefits is a big part of what's difficult. Similarly, people talked about we don't know counterfactuals. Same issue happens just with low interest rates. And we economists believe that lower interest rates should, over time, stimulate the economy and, in fact, get you back to a normal sort of level of interest rates and a normal growth rate of the economy. And yet people are angry. Interest rates are low and they're not getting the return that they want. And to say, yeah, but the return that you would be getting would be even worse if we left interest rates another percentage point higher just doesn't seem to resonate. And I think that sort of political calculus is important.
Yeah. Is just the banking system in Switzerland different so that we shouldn't generalize? I mean, as you pointed out, Denmark and Switzerland have had very different experiences. Is that just because institutional factors that make Switzerland different?
So I think this is a really important question that we need to look much more closely at. I think Jean-Pierre has added a lot of information today about what's going on in Swiss banks, which is really useful. We need the same type of information and the same type of analysis for other banking systems, and then we need to start comparing. I think that this is a new area. It's an area of research that's opening up, and these are differences that we need to understand. Mm-hmm. I'm convinced that institutional differences play a huge role here, and we need to understand better what those are.
So, Jamie, you pointed out that, yes, negative rates should make the yield curve steeper, except it depends what negative rate you're talking about. And I suppose also it depends on how long people think negative rates are going to be. If you're expecting negative rates for a long time in the future, it could do it. So, on balance, do you think that very low rates or negative rates are bad for bank profits, or is this just hyperbole from the banks who always like to complain about whatever it is the Fed's doing?
I think that from what we've seen so far empirically, I don't think they have negatively affected bank profits very much. Again, that's in the context of this constellation of policies, which include a large exemption policy on the reserves of banks held at the central bank. So,
you mean, that, just to be clear, so a large part of the reserves of the Swiss banks are not subject to this negative rate.
Right, they're earning
and that's
zero.
is that a unique feature in Switzerland compared to the others?
No, it's all of the banks have it to some extent, but it's especially large in Denmark, Switzerland, and Japan, which has very large exemption thresholds. So, so I think it's and again that policy tends to counteract the negative interest rate policy, at least to some extent. So it's hard to sort out the effects on bank profits. I do think that there will be, though, these sorts of financial innovations that Jean-Pierre was talking about, where you have competition from insurance companies and others that don't have to pay depositors zero, but can pay negative rates to wholesale funding.
And just finally, before we turn to the audience, is there anything we learned from Japan that's relevant to this part of our conversation, or is Japan just such a special case?
I think Cigna highlighted it, at least in part, which is how important communication is for the effectiveness of negative rates. I think most people in markets and maybe elsewhere were pretty surprised at the sequence of communications that culminated with the shift to negative rates. And I'm a general believer that effective communication makes monetary policy work more effectively. That's got to be even more so the case with negative rates.
Yeah, I was trying to imagine as you were speaking, the chair of the Federal Reserve explaining to the House Financial Services Committee that real rates are really what matters and nominal rates are just kind of an illusion. And I imagine the congressman from some state, will pick your favorite state, explaining that, well, Mr. Chairman, my constituents get paid in nominal dollars, so this real thing doesn't work for my voters. I look like a pretty heroic thing. Yeah, there's a question here on the aisle. If you could stand up so people can see you, tell us who you are, and keep your questions to questions.
Sure. Chris Faulkner McDonough with T. Rowe Price. So I have two questions, one for Signe and one for Jamie. The first question is, I was a bit surprised on your assertion about the impact on exchange rates. So for example, just take Japan as an example. Two questions. First, it seemed to appreciate. Second, it in particular, interest rate differentials, one thing that we've noticed on the trading floor is that interest rate differentials have mattered much less in explaining the movement, so it seems to be less driven by carry considerations. So maybe if you could expand on that a bit. And Jamie, I was really struck by your yield curve, right? Because if you think of it as kind of your workhorse assessment of financial conditions where we are in the cycle, given that there's now such a difference, does that imply that there's increased uncertainty in our assessment of where we are in the cycle? And should that imply higher interest rate volatility, higher uncertainty going forward, and how you've been kind of trying to reconcile that within the Fed?
I admire your attempt to get some useful information out of economists about exchange rates. That would be useful for trading, but it's worth a try. So, Signe?
So on the Japan case, it's this is a question that I will often get because the yen did appreciate before and after. But if you want to isolate specific event, if you look at the hours after the announcement, you will see a depreciation in exactly the way that we would expect from normal monetary policy impact on the exchange rate. That is one thing. That's what we look at. Everything else away from that window, that's the event window that we look at. Everything else is influenced by many other factors. There was a general trend toward appreciation. The second point is that we shouldn't expect very much from a move that was 10 basis points. So people look at this move into negative as being a big thing. Again, maybe we can think of it as money illusion. But in fact, they moved, depending on how you measure it, was 10 to 15 basis points drop from just above positive and into 10% minus negative. So we wouldn't expect a huge impact of the exchange rate, even in normal times, from such a move. We did see that impact in the hours after the event.
You have to trade fast. That's the answer. Jamie, on the yield curve question? Maybe you could state the question, because I didn't follow it.
The question
State the
was,
question you want to answer.
Yeah.
Whether or not it was
the
the one that was
question
asked.
I wanted to answer. What I looked at was the 10-year rate minus the policy rate, and then the 10-year rate minus the 3-month deposit rate, and showed that those diverged with the advent of negative rates in Switzerland. And so I don't think it reflects uncertainty. The question was, does that add uncertainty about where we are in the cycle and so on? I don't think it's necessarily an issue of uncertainty, but it's this desire as part of the policy design to exempt the retail part of the economy from the effect of negative rates and have the negative rates imposed not on the deposit funding institutions but on the market funding institutions. So firms like, who borrows in the repo market in Switzerland? It's sort of a question for Jean-Pierre, but I assume the insurance companies and other large financial companies can obtain these negative rates in their funding. Again, I just put that slide up there to show that banks had to do something else to adjust their profitability. Jean-Pierre pointed out they seem to have raised their mortgage rates, so that may, again, limit the effectiveness on easing financial conditions more generally. And the curious aspect is the wealth managers have not imposed negative rates on their
That's a misunderstanding.
depositors. Thank you. Yeah.
It's a the wealth managers had a lot of cash at zero rate. Of course, they got caught and
Right.
they were forced to do something. And they were terribly afraid of losing their clients. But in some cases, they did impose negative rates. And in other cases, they thought it was more creative. They suggested other investment products, typically in other currencies. And so that went exactly along the policy
that worked,
we wanted. Yeah.
that worked well. Yeah.
Miles?
Great. Thank you.
Wait for this is Miles Kimball.
So I think these are wonderful presentations, and I think one of the big issues is really this this political issue, and I think that really interacts very strongly with legal issues. So it really depends what central banks can do on their own. So my view would be that if you have a macroeconomic crisis, that most central banks would go to deep enough negative interest rates to do what's required if in fact they have the legal authority to do so. That differs from country to country. I would love to be able to have a real dialogue with some Swiss monetary policy lawyers and see what the details are. What I do know is
we won't be televising that.
Two other cases. Sweden has a very expansive monetary policy law, and so all the things, even quite radical measures, are legal there in Sweden. I've been Peter Conti Brown and I are writing a law review article about the law in the United States. And in general, in the U.S., administrative law is such that there's great deference to agencies, and if anything, there's more deference to the Fed. And so, in particular, the time-varying paper currency deposit fee at the cash window, which would be required to economically create an exchange rate, is the sort of thing that our initial discussion suggests that should be legal. The kinds of things I'm going to talk about this afternoon, some are tougher problems than others. Some of them might be in the jurisdiction of the SEC, for example. But I think you don't want to assume that it requires new legislation to do a very powerful negative interest rate policy. That really depends on the details. And one of the things that's very essential is for people both within and people outside central banks to be robustly debating these legal issues.
Thank you. I think we have time for one more question. Gentleman over here. We'll have more rounds of questions later.
Hi, I'm Doug Carr with Carr Capital. Interest rate arbitrage would suggest that if you're tamping down your currency by increasing a negative differential, that in order for returns to be equivalent on other asset classes from other countries, that you're building in an expectation of appreciation in your own currency. You've got a lower interest rate, so for that to be equivalent, it's going to be offset by appreciation in that currency. So how do you resolve that dilemma that you're trying to hold down your current rate, but you're building in an expectation of future appreciation in your currency?
I'll speak for the
I'll
Swiss.
take this. Because I face the same issue, as I've been thinking about this and reading Jean-Pierre's paper. But if you read Jean-Pierre's paper, and the point is that there's a large risk premium built in as well that breaks the interest rate arbitrage. So as Jean-Pierre showed, the investors in the Swiss debt instruments earned a lower interest rate over time, and that didn't lead to that's what prevented the appreciation, because they're being charged an insurance premium essentially.
I thought basically the point was that there's this relatively constant gap between the Swiss interest rates and the European Central Bank's interest rates, and that Switzerland, in order to maintain that margin, had to push rates down, and European Central Bank rates got so low that the only way you could maintain that was as negative,
Yeah.
right?
Absolutely, but you're right. But this is not inconsistent with the question, which is answered exactly by the fact that there is a risk premium. And so it's not, we have safe haven currency is bringing in something else than pure return. It's an insurance against tail events, and people are willing to pay for it. And that's the particularity of the Swiss franc.
Okay, we're going to take a break for about 10 minutes. There's coffee out here. Come back in 10 minutes. We'll start again at about 7 minutes after 11. Thank you. So we're going to turn now to Denmark and the European Central Bank. And I want to particularly thank our participants who came from abroad. It turns out it wasn't a great weekend to be flying anywhere in the world. We're going to start with Niels Hansen, who's the head of the economics department at the Danish National Bank. And the discussant will be Alex Rover, who's head of U.S. interest rate strategy at J.P. Morgan Securities. We wanted to kind of have a perspective from the markets as well as the central banks. And then we'll be followed by Massimo Rostagno, who really did make the heroic trip here. He's the Director General for Monetary Policy at the European Central Bank, presenting a paper that he has co-authored with a number of other people. I'm sure he'll describe that. And the discussant on that one will be Torsten Slock from Deutsche Bank. So, Niels, podium's yours.
must be up here somewhere. Oh, this is my presentation. So
Oh, it's already there.
yeah. I do like this. Yeah. Is this fine? Yeah. Thank you. So thank you for the invitation to come and talk here. It's an honor for me. I would also start by making a disclaimer that the views that I express here are my own and not necessarily those of the Danish of Denmark's Nationalbank. So we have already heard two presentations, and you'll see there are certainly similarities to the Swiss experience, but there are also differences, I think. Yeah. So how do I page down? How do I do?
To make it full screen.
Oh, thank you. Yeah. Yeah. So as you heard before, we went into negative rates almost 4 years ago. And apart from some months in 2014, rates have been negative ever since. If I should say our experience is in just one sentence, that would be they are a continuation of low but positive rates. In briefly speaking. That would be, and that's maybe somehow different from what we have already heard. But so here are at least some of the key lessons. I just carry on. So I would explain to you first something about our monetary policy regime in Denmark. We have had a fixed exchange rate policy since '82. Since '87, the central rate has been unchanged. You can see that here. This is a policy that is well understood by the public in the market, and it implies a distribution of labor in economic policies. That means that monetary policy is solely aimed at keeping exchange rate fixed, and so the stabilization of the economy must be up to other policies, in particular fiscal policy. This is a political decision. It has a strong support in the Danish public, amongst in the business sector, amongst economists, and so on. And that means, of course, that the central bank has a very strong mandate running this policy that we have done for so many years. You can see we are having a band of plus minus 2.25%, but in reality, fluctuations are much smaller than that. So what does that mean? When there are pressure on the Danish kroner, we don't see that in the exchange rate. So that pops up in other places, in foreign reserves and in the interest spread. Here I've shown the interest spread to our anchor economies. That is, in the first place, the German Bundesbank until '98, and then from '99, the European Central Bank. And you can see the different events here coming up in the interest spread. In the beginning of the '90s, there was the ERM crisis. There was the Asian crisis in the late '90s. We had a referendum on the euro in 2000. You have the financial crisis. Every time we have seen the interest spread going up, that means when something happened, there was a tendency for an outflow of capital from Denmark. Recently, this has changed, first with the sovereign debt crisis in some of the euro area countries, and lately here in 2015. So, you can say that when there is an up or downward pressure on the kroner, there are limits to how much we can intervene. That's limited by the foreign reserves, but interest rates can go up. When it goes in the other direction, there can be a limit to how low the interest rate can go, but in that case, we can intervene unlimitedly because we can just supply the kroner that is needed. Denmark has a big current account surplus, has that for some years now. It's actually right now around 7%. It goes back to 1990. Before that, we had a period as long with deficits, and we had a net foreign debt of 45% of GDP in the 80s or in the mid-80s. This has changed now to net foreign assets of a similar proportion recently. And this, of course, gives us net capital income of 3-4%, which is part of the current account surplus. Some of this is cyclical, some is structural, given the fact that we have built up a fully funded pension system and runs sound public finances and so on. But what it means for monetary policy, I think, going forward, is that the spread to the ECB is going to be low. And I think it's also likely that when things occur, capital flows can go in both directions, both inflows and outflows. So, just to explain a little bit more about the monetary policy, you can see here periods with capital outflow, that's the light gray areas, and with capital inflow, that's the dark gray areas. So take first, in 2014, there was some capital outflow, and what we see there in the first place, we do intervene, buying Danish kroner and also increasing Danish interest rates vis-a-vis those of the ECB, so we see the spread going up. The opposite is the case when capital is flowing in, and that's exactly what happened in January 2015 when the Swiss central bank lifted its floor against the euro. We saw massive capital inflow of a size that we haven't experienced before. We intervened, we reduced interest rate, it continued, and we ended up by reducing interest rate in 4 steps to minus 75 basis points. We also, at late January, announced a suspension of the issuance of government bond, which also curb the capital inflow. In beginning of February, 6th of February, we made our last reduction of interest rate and said that in this situation when capital is coming in, we can intervene unlimitedly. And after that, the thing changed, and we have seen capital flowing out gradually in the remainder part of 2015. In December, when the ECB reduced their rates, we there decided not to go with them, so the spread was reduced. And again, in January, we increased our rates, and again in March, the ECB, we didn't go with the ECB when they reduced their rates, so the spread has been reduced in 3 steps by 30 basis points, now down to 25 basis points. But what this shows is that we were able, with our policy tools, to keep the exchange rate fixed. So now let me go to the pass-through to lending and deposit rates. And look at the last 7-8 years here. There has been 3 periods with decreases in interest. First one was the financial crisis, and then the sovereign debt crisis, and lately the ECB response to low inflation and yeah. So you can see the green one is 1 month money market rate, and it has decreased significantly. But you can also see that deposit rates of Danish banks have come down on all 3 occasions. But the decrease in deposit and lending rates has been only gradual, and there has not been a full pass-through. So after the financial crisis, you can see that from having deposit rates that are typically lower than the policy rates, they are actually they turn into being higher than the monetary policy rates. And likewise, lending rates also went down, but less than the money market rate. The same is the case for the sovereign debt crisis and more lately here. We can see now that the deposit rate starts to be restrained by the zero lower bound, and you can see that for households, deposit rates are actually positive. They are more positive than I mean. One reason why they're positive is that you can have in a bank a mortgage loan where if you don't dispose of the money, you could put it on a deposit scheme at the same interest. When you correct for that, you get down to something here, dotted line, which is close to zero. So you can see now that the deposit rates are constrained by a zero lower bound. However, for large depositors, financial firms, insurance and pension funds, and large firms, actually banks have quoted negative deposit rates. And interestingly, actually, the lending rate more recently, since in last year, actually have come down by as much as the money market rate. So there has been actually a full pass-through in this recent episode. The interest margin has also shrinked a little bit, not so much, but a little bit. But it is still, if you look carefully at this, above the level it had before the financial crisis. In Denmark, our real estate is financed by mortgage bonds, by the issuance of mortgage bonds, and that means, and that's actually the biggest credit to the household sector, and also to the corporates goes actually through these mortgage credit banks, so these mortgage rates are determined in the financial markets, and that means that they can actually, there's no lower bound to these, and you can see that here in mortgage yields with short maturity have actually gone into negative, just like short-term government, the yield on short-term government bonds. Long-term mortgage yields are still positive, and so are long-term government bond yields. But as we've heard before, it means that the mortgage rates can actually turn into negative. But you should keep in mind here that not only do people pay these yields, but there's also a fee on that. But there has been occasions where actually the sum of this mortgage rate and the fee has been negative. I'll come back to that. So here, just looking at deposit rates in a bit more detail here. These are recent data on how different customer types see their deposit rates with banks, and you can see that insurance and pension funds actually have negative rates on most of their deposits. That's what we have heard also before. The same goes for some firms. It's in particular the larger corporations also have negative deposit rates, and that's actually something that we appreciate, because I mean that's part of the monetary policy transmission mechanism. It's important for the transmission to the exchange rate. However, smaller firms and individuals, they have not seen negative deposit rates. So you have here individuals to the right, and they have positive rates on time deposits and on those lending-related deposits that I talked about later. But on demand deposits, most of it is actually at a zero interest rate. So the zero lower bound seemed at least to have been binding vis-a-vis retail clients, smaller firms, and households. So now a little bit about potential side effects that we have also already heard about. I'll talk about cash, also bank profitability, the risk of an asset bubble or concerns about an asset bubble, and also a little bit about legal and technical issues. First, cash. I mean, we heard from Jean-Pierre before that there has been an increase in the circulation of cash in Denmark. That's right, but it's not an unusual development. It has been going on for a longer time, and we must say that we haven't seen any tendency for a cash hoarding in Denmark, and this of course reflects that the financial companies, I mean pension funds and so on, large firms, it's very costly to deal with cash, and that's one important thing here. And then also given that individuals have not faced negative deposit rates, also it's of course important for them not to hoard cash. And we also heard some of the reasons why banks would be reluctant to do that. I mean, Denmark is not a very cash-based society, and both banks, household, the authorities, firms, and so on, actually have a preference for not using cash, and that's, I think, a reason here. We don't have cash with the same large denomination as, for instance, the Swiss have either. So that also. But we also heard that there could be fixed cost to handling cash. So it's probably not only a question of the level of interest rates, but also of the horizon over which they are expected to prevail. So here I have depicted the area of between 0 and expected short-term rates here for Denmark and for the euro area, and you can see this area, at least for Denmark, has come down from compared to when the whole thing started. The pressure started in the beginning of 2015. It has increased again since last summer, but still we are not at the level that we were in the beginning of 2015. So the incentive to switch to cash was larger at that time. But I think that there is a time dimension that one should keep in mind here. On banks' profitability, as we've heard in the other presentations, but also in Denmark, there is some, I mean, with negative rates, pressure on banks' net interest income. At least if you look at the blue bar here, it seems to have leveled off. But at the same time, as you can see here, if you go back to last year, banks the result of systemic Danish banks was the best since the financial crisis. And what does that reflect? One is that with that net fee income has been rising gradually, so they have been able to compensate for this leveling off of net interest income. And you have seen also loan impairment charges going down, reflecting that the economy stronger now than it was a few years ago. So that plays also an effect here. And then beyond that, banks also made revenue from foreign exchange trading last year and remortgaging activities. So there has been an impact from negative rates on bank profitability, but I believe it's small and it's partial. And I would say it's more due to the interest rates being low rather than negative as such, and it has been compensated by fees, raising fees, reduction in loan impairment charges, and other things. So regarding asset prices, we haven't seen a bubble in asset prices. Here I show house prices in Denmark. You can see they have increased a little bit in recent years, but they are still below what our model would predict, reflecting growth in income and also low interest rates, of course. But it's definitely a matter of concern, both regarding financial and real assets, that in a situation with an economic upswing and very low interest rates, in combination, one should be concerned about systemic risk building up, but we haven't seen that so far. And if you allow me, just briefly on some legal and technical challenges that we have addressed and which might be relevant also in other cases. Regarding mortgages with negative interest rates, we need to find a solution to how do we deal with a situation where the creditor would have to pay the borrower. There are both there are tax issues. This has been solved. IT issues as well. It had to do with existing loans where you had to find a solution, and also with new loans where you had to write this into the contract. This has been dealt with. And then finally, on taxes, that's not a curiosity, but I mean all our laws and so on. I don't think they predicted when they were written that interest rates could become negative. So we have had to face that, and that means that, for instance, firms' tax accounts with the tax authorities, where they can pay in money also in advance at an interest rate that could not be negative. They had, of course, an incentive to do that when they had only negative rates in the bank. But this has been dealt with now in our tax laws. Just to mention that there are some issues here also to be dealt with. Yeah, so I've come to the end. So I will not read this. You can read it yourself. But these are, I think, key lessons from our experience with almost 4 years of negative interest rates. Thank you.
Hi, everybody. Thanks for, it's a pleasure to be here today. I want to thank David for the invite, and I want to thank Niels for his excellent presentation on the Danish experience with negative interest rates. I think, Denmark provides a really interesting case study in negative interest rates policy. I think one of the things that strikes me about Niels' presentation, well, the last point that struck me about Niels' presentation when he was talking about the tax changes that went through in order to accommodate negative interest rates. I think in the U.S. that tells us there's a chance for tax reform one day. All we need is negative interest rates first. Hopefully it doesn't come to that. But I think the other thing that I think is interesting is, from a monetary policy perspective, they have this explicit mandate to maintain the exchange rate peg with the euro. And as somebody who spends a lot of time parsing Federal Reserve communication strategy, how refreshing it would be just to be able to look at the exchange rate and say, hey, we're doing okay. A little bit of a different sort of story anyway, but let me figure out where the this the right one? I did want to comment a little bit more at length at a couple different aspects of the presentation. And really I wanted to focus mostly sort of on the deposit rate aspect of what was happening here. And if you remember sort of back in Neil's slides, it's around slide 11, there's a comment on sort of negative interest rates applied to different classes of depositors. So think of it as 3 bar graphs. There's a non-financial corporations bar graph, there's an insurance company and pensions bar graph, and then there's a households sort of employee and retirement bar graph. And the big takeaways there are, if you look at sort of the non-financial corporations, they have probably about 30% of their deposits at a negative rate, and most of the balance of it at a 0 rate. The employees, retirees, households, effectively they're exposed to flat interest rates, so 0 interest rates, or slightly positive interest rates in the case of their time deposits. And then in the middle, you sort of have this other category, which is the insurance and the pension funds, which is largely at negative interest rates, and I think is sort of a proxy for the financial sector in general. And one of the things that I'm struck by with respect to sort of the deposit rates here is there's a bit of a toothpaste issue, and what I mean toothpaste is, if you think about a tube of toothpaste and you pick it up and you squeeze it in the middle, the paste goes into either side of the paste. And money, I think, is a lot like that in the economy, and it's sort of interesting to watch what the differential and interest rate tiering, what sort of impacts that has on the markets. In this particular case, I think, when we think about sort of how non-financial corporations are reacting to the lower interest rates, there's a couple of different incentives, I think, working on them to try to minimize the amount of cash they have on deposit at banks, because they don't necessarily want to be exposed to those negative interest rates. So one of those incentives is to try to pass on excess cash down the road to shareholders, by dividend, by share buyback. I think that's something that we see not only in Denmark, but also other markets in the world. And in fact, in Denmark, Niels didn't discuss this, but in the background papers that I reviewed for this presentation, there's been a significant increase in dividends over the time of negative interest rates in the Copenhagen stock market. And so you can sort of see that's part of this mechanism of the non-financials trying to push money out. It's also the case, I believe, that if you look at sort of the yield-starved world we live in today, that there's an incentive on company managements to try to increase the amount of their payouts, the size of their dividends. It actually comes in terms of a higher PE ratio in a lot of cases, and so I sort of think that's sort of been the case here. So take the negative yielding asset, try to pass it to a place in the economy that isn't necessarily, or is a higher yielding place. So money sort of moving that direction. So think about cash moving more in the direction of households. The place in the middle that I think suffers is sort of the insurance and pension fund and sort of financial sector. We think about sort of the financials are the most exposed to negative rates, and I think part of this is by design, or maybe all of it's by design. If you consider, for instance, Basel III and some of the incentives that exist in there, there's effectively a mechanism in there that's trying to minimize connectivity issues between financial institutions, and so we see this, I think, both in terms of the rate positioning here. We also see it, not in this particular nominal rate space, but we see it in terms of costs that are passed on by banks to depositors' fees, that sort of discourage the use of certain types of non-operating deposits. In the case of sort of the insurance companies and pension funds, they're incentivized, I think, by the negative rates that they have to try to go out and pursue higher yielding assets with the balance of their investments. Not that they're particularly focused on short-term deposits in the first place, but the rise of negative interest rates has definitely had an impact in terms of lowering yields across the curve, and I think causes these institutions who primarily are sort of paying off insurance policies which may have an embedded return to the policyholder, or pensions that have an embedded rate that has to be met. It creates a problem for them because they've got to go out and pursue what has been sort of increasingly falling yields or increasingly sort of scarce supply of yieldy assets. And yet at the end of the day, they have these liabilities that they're going to have to make, and largely these liabilities go to the household sector, either through the insurance policy or the pensions. So, maybe the depositors, the households aren't experiencing negative deposits up front, but down the road they're going to have potentially issues with pensions or insurance returns when it comes time for retirement. And that gets me to the point that I wanted to sort of get into a little bit about bond yields, because I am a fixed income person. I had to bring bonds into this. So I'll just share a couple of quick snapshots here. We have seen as negative interest rates have become a more used strategy across central banks, we have seen increasingly a demand for fixed income. And if we look at a broad-based index of global bond yields, such as the J.P. Morgan Global Government Bond Index, you can see sort of the downward pressure on yields here on the right-hand side. The average yield on this index is currently running about 1%. If I look at that index and I look at sort of the percentage of that index that is comprised of negative yielding bonds, it's currently about 28% of the entire index, which is pretty significant. To bring this back to sort of Denmark and their particular situation, we've actually sort of mapped what the negative yield universe looks like, and this is across the countries that are on our GBI broad index. This is our broad government bond index. You can see listed down the side is the size of their negative yield holdings. Now, I would tell you in aggregate that we're just shy of $6 trillion of negative yielding assets in this index. The total index is just shy of $21 billion. So again, that's your 28% number coming up there. You can see Denmark is contributing about 48 billion U.S. equivalents to that, so less than 1% is their representation. But I think it's sort of interesting to look at, coming back to this issue of investment and trying to find yields. If you're a Danish institution, the distribution across the different parts of the yield curve, 1 to 3, 3 to 5, 5 to 7. We've really sort of seen, over time, the negative yields move further out the curve, and I think that's been experienced in other parts of the world as well. Most predominantly in Japan, where you can see basically the entire yield curve is effectively at negative interest rates. And by the way, they're about 3.2 trillion of the nearly 6 trillion. So the big bond market in Japan, but Denmark relatively small. And I think the Danish central bank certainly has their work cut out for them, trying to run their own economy and trying to stay balanced between the ECB and the other sort of Nordic countries. And their issues as well. So I guess that's sort of it. I mean, one of the things I think that we've seen from a markets perspective, as we've seen more prevalence of negative rates, is it's increasingly difficult for investors to try to find the yields that they want to. So if you sort of think about all of this, if you think about, if you take the sum of all the government debt outstanding and you subtract out what's held by central banks and figure out sort of what's left that's positive yielding, about 48% of the positive yielding debt not held by central banks in the world is U.S. Treasuries. So the impact of negative rates elsewhere is definitely being felt. If you happen to be an investor in the front end of the curve, you can see, just sort of looking at the zeros going up and down the 1 to 3 year column, you have relatively few options available to you. And so I would say Treasury debt probably makes up something closer to 3/4 of the supply of the world's debt there. I'll stop my comments there, and thanks.
Thank you, David, and the organizers for inviting us. We are very grateful. It gave us a very important opportunity to sit down try to straighten up a little bit our thinking about these policies that have kept us busy for a while. And when I say we, these people there, me and my colleagues at the ECB, doesn't implicate at all the people who are mentioned down there in red. And that's very important for you to appreciate. Now, let me start from this chart because it gives you the backdrop against which these policies were adopted. And the main message of my presentation is that this policy is really falling, at least in our perceptions, in mine and my co-author perceptions, into the credit easing package that the ECB has been adopting since 2 years, full 2 years now. And is motivated by this picture. So you have here a central bank that has a price stability objective, is mandated to stabilize inflation. In that definition, the blue line, the light blue line that you see on the left, is the preferred definition of inflation for measuring whether the ECB is delivering on its objective. And the ECB has declared that it wants to bring inflation to not too far from 2%, so below but close to 2%. So that's the objective. You see also that that line, the blue line, has fallen short of this horizontal 2% line now consistently for a number of years. Now, that situation was not judged to be of particular concern at the beginning because it was a reflection of these inflationary forces that were imported from overseas, as the oil and non-fuel prices were collapsing. They started contributing negatively to the inflation index, so that was not seen as particularly concerning. But at some point, those green bars that you see, which is the contribution of underlying factors to the main index, started to become more and more important in explaining this drawn-out process of disinflation. And so that was a time when this process started becoming a very, very heightened concern for the ECB. And also because that process sort of infected inflation expectations. You see now the inflation expectations, market-based, in this purple line, that means struggle getting up to 2%, even at very long horizons. And in a situation in which the economy itself was struggling, getting back to the level of real GDP that it had at the beginning of the crisis, only this quarter, probably last quarter, we again managed to achieve that level. That situation became very concerning. Now, if that is the situation, as somebody said this morning, I mean, this is a negative rate policy is a natural continuation of what you would do in other circumstances if you need to inject more accommodation. So you just cut interest rates. If those interest rates are already at zero, you cut to negative rates. We have, so this is the chart. This is the first steps of the transmission mechanism. This is money market, overnight money market. You see we have a corridor system, so we can bracket the volatility of this red line or orange line, which is the operating objective of the ECB, is an overnight interbank money market index for borrowing conditions across banks. And if you pull down the floor, so the deposit facility, so the rate that ECB pays banks when they deposit excess liquidity with the euro system, then you pull down this green line, this red line, also to negative. And it is only after these 4 small steps into the negative that ECB took since June 2 years ago. Now it's trading quite stably in the negative territory. In fact, quite close to the lower end of this corridor. So I will be very selective because I have very many slides and very little time. So I will not go very far here in this overview, but I will start, and that's probably the most important thing I'm going to say from my perspective is that. The way we I and my co-author view this policy is that it rehabilitates and somehow it re-empowers policy in conditions in which policy is obstructed, as you know, by a number of limitations that one encounters when interest rates are already very low. And we have a simple model way to show this. Now, it's even simpler what I'm going to present here. So really, you need only a couple of equations to sort of convey the idea why this policy may somehow empower monetary policy. Then I will ask what happens to transmission, particularly bank-based transmission, which is so important in your area. Banks suffer, are thought to suffer very much in this environment. So what happens there is important for transmitting stimulus. And then one thing on bank profits, if I may get there. Now, the primary reason that we see, we again authors, for this policy is that this policy is not a calamitous misadventure as it was portrayed. It was characterized in these commentaries, nice commentaries that we were getting at the beginning of this year from press, from reports and so on, from market participants. It is not a calamitous misadventure, but it is in fact a way that could be even an efficient way to, again, as I said, re-empower, rehabilitate monetary policy in very difficult situations. And the main reason is probably conveyed visually in this chart. So it's a phenomenon that was studied since the very beginning when advanced economies bumped into this problem of very low interest rates, zero interest rate. Keynes was writing about this. So it's a phenomenon that when a central bank brings short-term rates to zero, then investors start expecting that short-term interest rate cannot fall further, so they can only increase from that level. And so they start fearing that if they invest long-term, the interest rates are so low that they are not going to compensate them for the risk, no interest rate risk that they are going to expose themselves if they invest long. So they rather keep liquid, and so that's the main rationale, the main description of a liquidity trap. And I mean this is not innocuous for the central bank's purpose. It runs against the central bank purpose because the central bank wants to cut rates, wants to cut long-term rates because those are important for demand. But it cannot because of this mechanism. So the market moves against the central bank. And so it manifests itself now that we have these instruments. This is a three-factor arbitrage-free shadow rate of the shadow rate model of the last generation. So you can study the predictive distribution of interest rates when there is a central bank policy action. And that is what we saw when the ECB cut interest rates first to zero in July 12, 4 years ago. That the whole distribution became very much upward asymmetric, and the ECB realized that the rate at the long end of the curve were not coming down at the same pace at which it was cutting rates in the short term. So there was this say perverse effect running against. Now, if this problem can be solved or can be somehow ameliorated by convincing investors that there is no non-negative restriction on interest rates, then that thing is, of course, becomes better. No, that phenomenon becomes less severe, and you can move. In fact, and this is the picture that we took on the basis of this model, the same model, when the ECB cut a second time into negative to minus 20 basis points, that the whole distribution collapsed, and came down very, very sharply. So this is important because you can, in a sense, make banks internalize this pecuniary externality that they have because they take a rational decision. They want to hedge against interest rate risk. But by doing so, they are de-empowering monetary policy. So they are having a negative repercussion on the pricing of long-term assets. If you want to cure that, then probably the negative interest rate is an option. Let me skip that and go to this very very simple thing. Now it's a two period economy. Investors are mean various investors. There are two securities. One is a short-term security that has a secure interest rate R1, and it's fixed now, so that's very 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 certain. And there is a long-term security that pays in 2 periods as a yield to maturity now, but the return, exposed return, will not necessarily be equal to the yield to maturity. It is subject to volatility, and the central bank can influence the price because of its monetary policy. Now, in this economy, you have the yield to maturity today of the 2-period security is given by a very simple formula. You see that there is a term premium also showing up because these are mean variance investors. If there is a positive supply of long-term securities, that is going to show up in the pricing of long-term rates. Now, we have a central bank. The central bank has a Taylor rule. It's a very simple thing. By the way, it's in differences. Taylor rule is differences, but it doesn't change at all any substance of what I'm going to say. So it's just for a presentation of purposes. It makes things easier. If there is no consideration of lower bound, for example, because you are starting from a starting position which is way above zero, and nobody even understands or cares about the lower bound, then all agents, all investors take that reaction functions into consideration when forming expectations about long-term rates. And they just say, well, the central bank has a preferred rate to set, a target that we call S. And so I just take expectations of inflation surprises. Central bank will react to inflation surprises next time. And on the basis of that density or probability function inflation surprises that you see there is a bell-shaped normal distribution. I just take the expected value of that distribution. Very simple. But if you start from a very, very low interest rate situation already, then agents start internalize that the central bank may not go below zero, if there is a communication about a lower bound. And so the next time interest rate is not necessarily the preferred interest rate of the central bank, S, but it's the lower of S and the lower bound itself. So there is a constraint, and in forming expectations, they don't use the whole distribution of inflation surprises for next time, but just a portion of it. So they take an expectation, an expected value of a censored, normal in our case, distribution, which you see there. So that is what keeps interest rate. And what is very important, I think, and nice for us to see that is so easy to demonstrate, is that the reaction of long-term rates to central bank actions changes very much from a situation where you are way above the lower bound and a situation where you are very, very close to the lower bound. So if you are way above the lower bound and the central bank cuts the rates, that is going to have a linear negative response, trigger a linear negative response in the expectation next year or next period long-term interest rates. Whereas closer in the vicinity of the lower bound, that is not going to be the case because that relation that links today's monetary policy decisions and tomorrow's expectations of tomorrow monetary policy decisions becomes convex. So there is a weaker and weaker impact on rates. Now, what are the options? One is the usual, by now canonical prescriptions of our profession, just lash interest rate to zero, promise to keep it there for long, probably in eternity. So it's a sort of has been called Odyssean type of forward guidance. So the central bank in this very simple model says, okay, I will not react to inflation surprises next time. So be happy and very relaxed. I will keep interest rate at zero for 2 periods. that gets you a very flat term structure. Now, if the central bank cares about the term structure, wants the long-term rates to be as low as possible, probably this is not the best it can achieve. If it adopts a NIRP, so a negative interest rate policy, it doesn't have to commit to anything. It just slash now interest rate to below zero, and then it keeps reacting to events like according to its standard reaction functions. But in certain conditions, that can beat the policy that you saw before. So it can go better. It can make things better, at least if its intermediate target is one to keep the long-term rate as low as possible. So you see that it can be an efficient policy. Now, not necessarily, you have to assume many things, but if that is the objective, it can be very efficient. Now, what was the impact in reality? Well, the impact in reality you see there, you see the pre-June 14 quasi-risk-free curve, swap curve in the euro area, and you see now in the yellow a very recent snapshot of that curve. You see it has, well, first of all, it has fallen very much, quite a bit. It has not necessarily flattened a lot, and so that's also something that one should keep in mind. But probably the best, say, test of efficacy of this policy is to see what happens on the bank lending channel, because that is very important for the euro area. You know, before these policies, well, not only the NIRP, but also quantitative easing, credit easing of various forms that has been adopted since 2 years ago. Before those policies, there was a very notable, very disturbing pullback in the provision of credit supply, and very, very disturbing, very damaging also downstream effects to the borrowing conditions of households and firms in the euro area, particularly in some countries. You see there the average lending rate per country. And you see there was a huge increase in dispersion, increase also in levels in some countries, despite the fact that ECB had been easing policies also more, very, very consistently before. Now, instantly after the announcement of this policy, and you see when this light gray time window starts, interest rates started falling like rocks in the euro area. Now, again, that was not the only policy announced. There was also another longer-term refinancing operation targeted for banks not to target their borrowers. So many other things. But I mean, visually, it's quite amazing to see that picture, because now there's been a reintegration of this market, these credit markets across the euro area. And also the levels are at historical lows. Now, the interesting question is to disentangle the impact of a pure negative interest rate policy. This is what some colleagues of ours, one is also a co-author of this presentation, have tried to do. Just using micro data, so individual bank balance sheet data, and using a panel fixed effect model to extract really the impact, isolate the effect of the NIRP on lending condition. What they find is that because there is a very big degree of cross-sectional variation in how liquid banks are, in the euro area. For example, in the core, banks tend to be a lot more liquid than in the periphery, so they retain a lot of this liquidity that is being created under the quantitative policies of the ECB. So you can exploit this cross-sectional variation in liquidity distribution and see, and then match those liquidity holdings with other characteristics of banks, and see whether the fact that a bank that has a lot of liquidity, and so is paying a lot of charge, very big charge to the ECB to maintain those liquid balances, is explaining their lending behavior. Now, what they see is the following, that indeed those banks that get a lot of liquidity are those banks that have an incentive of cutting rates, so expanding loans, or pay down debt, market debt. European banks have a lot of market debt, wholesale funding, so they can always pay down that debt, either because they buy back or because just those securities get redeemed. And so in this way they can substitute funding that is still very expensive to maintain on the balance sheet with funding that is very inexpensive to maintain. Now, one word, and then I stop on bank profitability. Now, of course, this is not a policy that if you maintain this policy for a number of years can be beneficial to banks. That's everybody understands this. But for the time being, and when I say for the time being, also including projections, including, for example, what we expect to see in 2017. This is an analysis that was done forward-looking with some assumption and some projections. You see that there are factors that are pulling up return on assets in this case. So factors that are pulling up return on assets and factors that are pulling down return on assets. And those are averages across banks in various countries and in the euro area. And you see that, for example, whereas the net interest margin is, of course, a factor that cannot contribute positively to banks' profitability, not at all. This is not the only thing that is at play here. There are others, and one particular is, one is the fair value revaluation of portfolios. And banks, not only in the periphery, but also in the core, particularly German banks, are very, a lot of securities on their books. So those securities got revalued because short-term rates have collapsed and long-term rates have collapsed. So that, to the extent that they sell those securities or they value the securities to market prices, this is beneficial. This is very short-term, but there is a more longer-term effect that, in fact, is picking up as we look further out in the horizon, which is this yellow thing, the credit quality. And the credit quality, so in a better economy, the capacity of borrowers to pay back their loans improves. This is already very visible in banks' accounts. In 2015, for example, that was a very big factor, keeping up, in fact, increasing profitability of euro area banks, because there was a decline in impairments, a decline in provisions for bad loans. So that is something, as a factor that is very important for the periphery, not so much for the core, but you see it's increasing. Thank you. I stop here.
Thank you so much, and thanks to David also for both inviting us all and putting this together. I feel that a summary of the presentation so far is that we could put a banner up here in negative interest rates, mission accomplished. The question is it really true that we can make that conclusion? Are there reasons why we should be worried? And I can tell you from what I do in my job, I go out and talk to investors everywhere in the world. I have hundreds of client meetings every year. And I have, up to this point, not met yet a single portfolio manager who says, this is a really great idea. Most people who sit with their monies and basically manage and think about what they should do and where they should invest, come to the conclusion that this is just really, broadly speaking, annoying, and it's something that's really difficult to deal with. And therefore, the most important conclusion, in my view, is that there are actually some confidence costs that are extremely important, not only for investors, but also, as we've talked about earlier, for corporates. How do corporates think about this? This is a very non-linear effect in terms of corporates' behavior. How do households think about this? One very important fact that's indisputable is that for the last several years, we've seen the wealth effect on the consumption function basically being cut in half. Why is it that consumers are so cautious? Why does it need to take such a significant increase in asset prices, most importantly stock prices and home prices, before we will see the positive impact on the economy? Does that mean that we need to see much bigger increases in the S&P 500 and home prices before we'll get that recovery that has been so, unfortunately, long relative to what we've seen earlier? And the problem is that quantifying these confidence effects is very, very difficult. But what I try to do here is just to add to Massimo's excellent analysis, some attempts of showing some charts and data for why we have not really accomplished this mission and why there are all these issues still that are outstanding, whether this is actually working. Most importantly, in my view, if this is really such a good idea, why don't we just lower interest rates to -5 tomorrow? And then we'll have a very quick recovery and everything should be good. Well, there must probably be some reasons why we have some other issues, why this is not just such a good idea. In other words, maybe there are some nonlinearities when we do get closer to zero, which are worth thinking about. And all those fall basically in the camp of what are the confidence costs relative to the... It's not that the economic benefits are zero. Maybe there are some small benefits, but are they really worthwhile relative to what we see in terms of the costs? So therefore, the starting point, of course, is to ask, what is the problem for Europe at the moment? Of course, other discussions similar for Denmark and Switzerland and Sweden, you could ask similar questions. But one issue, of course, for Europe is that, well, of course, headline inflation is low. And this is very important, driven by oil. Massimo's chart shows also this, that the core inflation has been around 1. It's actually been going up a bit more recently. In fact, headline inflation only started falling in 2014 when oil prices started falling. So you could say, well, maybe we shouldn't do negative interest rates. Maybe we should just change our target. This is not revolutionary. I mean, the Fed is targeting core inflation. Many other central banks are targeting core inflation. We're not even proposing, as we did in the Geneva report, to raise the inflation target. This is just to say, maybe the justification for doing negative interest rates was completely wrong. Maybe we should just have looked at core and said, well, this is all solving itself over time, so maybe we should not be so worried and therefore attempt to deploy all these alternative measures. Another issue, of course, which gets to a whole different discussion, but maybe it's not only inflation that's the problem. In several southern European countries, we've had a big problem with youth unemployment. This is a very serious issue. And is the solution to that to lower interest rates, to do more QE, to do credit easing? I mean, the obvious answer here is absolutely not. A much better solution to that is just to give tax subsidies to firms hiring young people, or to basically give higher transfers to incentivize people to take more education. A very important issue here is that there are a number of other options that we can do than monetary policy, and we just silently accept that, oh, well, fiscal policy and structural policy is not working, so of course we just have to do all the work ourselves. And the question is this really the right way to look at it? Another chart that illustrates this is this one here, where the Access to Finance survey asks smaller and medium-sized enterprises, what is the most important problem for you as a company at the moment? And as you can see to the right, they do say 10% of them that it is a problem with access to finance. But this is the smallest problem of everything. The other problems you have here, regulation, finding customers, skilled availability of skilled labor, competition, cost of production. This is all fiscal and structural policy. What's happening on that front? Basically nothing. So that also comes to the solution here. Is that really that we do monetary policy as a response to the problems that we have in Europe? It's not that those problems are small. They are very, very big and very serious. I'm not saying this lightly. I think some of these issues should have been addressed a long time ago. But the question is again, and this is a very important issue in particular for Europe, should we just say, okay, well, the other types of economic policy, as you know too well, there's fiscal policy, structural policy, and monetary policy, and other two types. Oh, it's just not working, so we'll just do everything we can to try to not quite bail out, but at least do something to support as long as these other types of policies are not functioning very well. So the issue, of course, then becomes, well, if the ECB and central banks elsewhere, of course, basically continue to push as hard as they can, what does that then do to the willingness to reform and the willingness to try to support your economy? And I used to work at the OECD, and the OECD has a number of different measures of structural reform and structural reform momentum. And on the x-axis here, you have, for different countries, the responsiveness rate, which is a very diplomatic way of saying countries that have done something on structural reform. And from 2011 to 2012, a number of countries did a lot on structural reform, including those that I have circled there to the right. What I have then on the y-axis is the change in momentum from 2011-12 to 2013-14. And as you can see, momentum has just basically stalled in a number of areas, and basically most prominent in the periphery, but also in other countries that you saw a lot of reform momentum in 2011 and 2012, just after the European crisis. But I'm not saying that the ECB is causing this stalling of the momentum in reforms. but I'm just saying that there is a very, as much as it's incredibly unpleasant for all of us, there is a very, very important link between what monetary policy is actually doing and what fiscal policy is not doing. And that's a very important thing to continue to keep in mind, that economic policy in every economic textbook is not only monetary policy, but it's also policies elsewhere. And this chart, unfortunately, suggests that momentum on the structural reform side has basically been stalling more recently. The more serious issue in a broad perspective is, of course, that the ECB is then experiencing quite a decline in trust. You could then say, well, why does that really matter? And it may not matter that much, but what this is at least telling you is that the trend is not your friend in broad terms here, when the population across countries basically starts losing confidence in you as a central bank. And this, of course, is something that also needs to not be taken very lightly, that the impact of policies, and I'm not saying this is negative interest rates, there are a lot of issues that go into this. You could also ask, do people actually understand what the question is, and do they understand what their responding is? Do they trust that they will succeed? Do they trust that they're doing the right thing? I should also add that this is not only for the ECB, this is also for the Parliament and the European Commission, so this is a European issue more broadly. But I'm just saying that there are still also some issues here in terms of credibility and the way that we think about how these alternative policies are working and pushing things forward. Another issue when we then start thinking about, well, are these negative interest rates specifically something that has changed behavior in the banking sector? And the ECB has a great bank lending survey where they ask banks, as you can see the bold subtitle there, direct and indirect contribution of negative deposit rate on lending volume. In other words, you go out and ask, have negative interest rates have any impact on your lending? And to the left, you can see loans to enterprises. And the light blue are banks that basically say it's basically unchanged. In other words, it's basically had no impact whatsoever. The red is somewhat considerably lower, which is, of course, somewhat surprising. But the dark blue is where you start to see some impact, namely banks that are saying, yes, negative interest rates have actually had a somewhat or considerably higher impact on our lending volume. But again, I understand, of course, fully that we have only lower interest rates just slightly. But the issue here is that if 80% of respondents say this has no impact whatsoever, then you should probably be a little bit worried that maybe this policy is not as useful. I understand that it has an impact on market rates, and that's also very important. But generally speaking, if the response both on loan to enterprises and to households is that the banks are saying this is not working, then this is probably also something that's critical for how we think about this policy. Just for completeness, there's also a similar question where they ask for QE. So this is if you read again the bold text below here, share of banks for which increased liquidity due to QE had basically no impact on lending. And again, we're up in the 80% of respondents saying this basically doesn't really work, or at least it doesn't impact our lending decisions. So again, this also suggests that it's not just lowering interest rates to -3 and then go out and play golf for a few months and everything will solve itself. There are a lot of issues involved in that you cut through the threshold, and what I would say, again, confidence effects, or call it nonlinearities, that are very important in terms of people changing behavior. And finally, an issue that we also have talked about earlier is, of course, what does this mean for the rest of the world? This chart here shows you negative interest rates in different countries. 1 to 10 is the maturity of different government bonds. In Switzerland, we also talked about this earlier, the negative interest rates up to 10 years. Japan, the whole yield curve also. Germany, 8 years. Austria, Belgium, Netherlands, 5, 6, 7. You get the idea. The whole point of this chart is that the ECB probably would love to see this chart. The more red, the better. Because the idea is to ease financial conditions, and the more red this is, the more easy financial conditions are, and the more it would support the economy. But if you are a real money manager in Europe, and you look at this as your investment universe, and you say, where should I put my money? It's not a surprise that many people in Europe basically vote with their feet and go somewhere else. The red line here is the net portfolio investment of fixed income for Europe. So this means not only European money managers, where do they put their money, also are foreigners investing in European fixed income. And as you can see here, we have never seen such a significant outflow of money from European fixed income, because who wants to have negative interest rates? If you're an insurance company, if you are whatever pension fund, of course you would decide to go somewhere else. And we're seeing that to the tune of around 600 billion at the moment, which is by any metric going back in history, bigger than what we have ever seen before. And who's the main beneficiary of this? Of course, U.S. Treasuries are one of the main beneficiaries, partly because the market is so big. But the blue line here, this is from the TIC data. I should read the bold text here, net foreign purchases of U.S. Treasuries. And the blue line shows you private buyers of U.S. Treasuries. If you look at the beginning of 2015, at the time I was traveling in Germany and in Amsterdam, and when you met money managers there, that's exactly when bonds, 10-year bonds hit zero. Everyone basically said, I've had enough. I just don't want to have European government bonds anymore. Just give me some treasuries. No matter what the outlook is for the US economy, I would much rather have high yield elsewhere. And you could show the exact same chart also for corporate bonds, investment grade, high yield. There's been a significant inflow into US spread product, meaning investment grade and high yield, as a result of negative interest rates, not only in the euro area, but also in the US, which basically, as a footnote, opens the door for the US and US financial markets. All these tourists that came into US fixed income, but didn't come because they worried about what the outlook is for US rates, but they basically only came because of this chart here. How worried should we be about that if we do start to see inflation in the US, if we do start to see the economy reaching full capacity? And that's the final chart that I have here, namely, what is the main problem with this, and why should we worry about this from a financial stability perspective? This chart is embarrassingly simple. It just shows you the unemployment rate. The blue line is in the US, and the red line is in the euro area. The blue line is the unemployment rate today, as you know, is 4.7. This is very close to the 2005 level, which you could say this is probably some estimate of the neighborhood. In other words, some estimate of when you should start to see wage inflation and consumer price inflation. There are also much more sophisticated ways of calculating that, as you know. But the bottom line is the US is probably very close to full employment. This is also what several FOMC members are saying. So in that sense, it probably makes sense that the Fed is starting to thinking about hiking rates. But look at the red line. In the euro area, the unemployment rate today is 10. But where is the neighborhood in the euro area? There are various estimates that says that it's a little bit higher than in 2005. But let's just say that it's around 9, where it was in 2005, where we had high wage inflation in the euro area. We also had high consumer price inflation. But that tells you, if you put your ruler down on that, and as you know, in the economics toolbox, that's one of the best tools we have, you end up saying, when will we hit full employment in the euro area? And one answer is, okay, maybe the ruler is not fantastic here, but let's just say in the next 1 or 2 years. Think about what that really means. That means that in the next 1 or 2 years, we'll see IG Metall start asking for higher wage increases. We'll see upward pressure on inflation across the board. In particular, if the euro goes down again, which is what everyone expects, then you should also see more inflationary pressure. So think about what it really tells you, that in the next 1 or 2 years, we could see inflation in the euro area. But how are investors positioned for this? Look at Germany. Investors now believe that interest rates will be negative for the next 8 years. In other words, the risk is that all investors will come back big time out of the same door, which will be very narrow, and therefore this will turn blue very, very quickly the day we start to see inflation. So in my view, I think the main problem really here is that we are at significant risk that the slightest hint of inflation, first in the US, and in the next 1 or 2 years in the euro area, could basically reverse these policies and create an enormous amount of financial instability. In the worst case, simply because a lot of people have invested in products now, not because they like the underlying cash flow of those companies or whatever asset they have bought, but simply because they did it under the expectation that the carriage rate would continue for the next 8 years. So on that note, let me stop there.
Okay, we'll now be serving drinks. I think I'm just going to ask a question or two, and then we'll go to the audience so we can stop. And I'm hopeful that we can broadcast the Janet Yellen's remarks beginning at 12:35. Massimo, do you want to, when you get your mic, do you want to say anything in response to Torsten's indictment about how the ECB is completely playing Russian roulette with the American and the European economies?
No, I'm many things. Many things. One thing I'm totally in agreement is the fact that we see very little in terms of structural reforms. There we see some stalemate in the drive for governments to adopt structural measures that may repair those economies in a lasting manner. But and that's something, by the way, that ECB is always emphasizing. Perhaps somebody, I'm sure for American taste, is even too much. Discourse on other policies. I don't think the Fed would ever give prescriptions to fiscal policies or even less to labor market policy makers. whereas the ECB does very often, and so because the Governing Council clearly and genuinely believes that in a more flexible economy, in a better functioning economy, monetary policy would be really more effective. And there would be less need for monetary policy, as Torsten has said. Where I don't agree, however, is the fact that we, central bank that has a very narrow monetary policy mandate. It's very, very narrow. If you read the treaty, we say we have been given a hierarchical mandate. First, ensure that price stability is there, and then do whatever may be beneficial from the point of view of the general economic objectives of the European Union. This is the way our mandate has been structured and hierarchically. So it would be very difficult for us to get involved in any quid pro quo type of game with other policies, whereby we say we don't ease policies, although inflation is falling like a rock, just because we don't see so much coming from your side. That would be really unlawful. And so that's the answer. By the way, it's not, as I try probably not eloquently enough to say and to claim, it's not only a matter of oil. It's not only a matter of oil. It has been a matter of oil at the beginning. So the unwinding of the positive contribution of high oil prices to headline inflation has proceeded for a number of quarters, I would say, where the ECB was, by the way, very patient, responding to that situation, because it saw the factors being, again, imported disinflation, so not so worrying. It became very worrying when the ECB and staff realized that the core was starting to react big time to that situation, and in fact now it is not increasing. It in fact is decreasing. It was hovering around 1% for a couple of I think for a year, an entire year. Now is lower. Has been very much lower in April. It went up a little bit to 2.8 in May. These are rates that if are maintained, and by the way, we have evidence that inflation is attracted in the medium term by the core. So the medium, which is what everybody should expect, when all erratic factors will have ebbed away, what will prevail will be the core, the fundamental drivers. If that is the situation that we are looking into in 2 years' time, that's not satisfactory. That's not consistent with our mandate. Our mandate is to stabilize inflation at medium-term horizon, not too far from 2%. 0.8 is definitely too far from 2%.
Niels, let me ask you a question. A couple of people have mentioned that, well, there may be benefits to negative interest rates, particularly if you take fiscal and structural policies given, but there are costs to confidence. Do you see that in Denmark? Does it shake people up, that this weird situation where rates are less than zero?
I don't think so. Oh,
it's on.
Sorry. I think and as I stressed in my presentation, the Danish monetary policy has been in place for many years. It's very well understood what it takes. The central bank has the exchange rate as its sole objective, so we do what it takes, and that has been well understood also in recent years. And politicians know that as well, so they know they have to do their part of the job. But no, I don't think you can say that.
Politicians know they have to do their part of the job. That must be a Scandinavian thing. Alex, are you as terrified as Torsten is about they're playing with matches here?
I wouldn't say terrified. I think there are a lot of unknowns about how the negative rates manifest themselves, and Torsten talked about sort of the international flows in his in one of his charts. it's a really powerful thing. It's the Fed, it doesn't have an explicit mandate to manage the level of the dollar. Yet we continue having every time it thinks like it's getting ready to move interest rates higher, seems like we have a surge in the dollar, and that seems to put the brakes on what's happening here. So I'm not entirely sure that as the world's reserve currency with an increasingly large part of the world's sovereign debt moving into negative territory, that we completely have control of what's going on there.
But that's a condition of if we're going to have easier money abroad because they have weaker economies and tighter money here because we have a stronger economy, yields will be higher here, money will flow, and the exchange rate will go up. That's not a condition of negative rates. That's what happens when you have countries.
It's being on the receiving side of it. I mean, I think there's a received effect of negative interest rates from elsewhere in the world.
All right, so it seems to me, let me just ask one question to Torsten, and I'll go to the audience. I don't care about portfolio managers being unhappy. The objective of fiscal and monetary policy
managing your pensions
is not to make portfolio managers happy. The point of fiscal and monetary policy is to get us closer to reduce the output gap, encourage investment. So by that standard, do you also think that this is a failure?
No. So, no, I completely agree. The idea is not to make portfolio managers happy. I mean, I think the more serious issue is, as I mentioned, the wealth effect has fallen.
Right.
Corporates have basically also enormous amount of cash, and you really ask why and this is not only negative interest rates, but you really ask why they're hoarding cash to such a significant degree. So a lot of issues that go into what are the implications of having such a weak recovery that's taking so long? And this is not only a European issue, this is also a very US-oriented issue.
So if I hear you right, it's not that you think that negative interest rates are causing this. You think that we have something wrong with the economy. Better policies would be fiscal and structural. And given that we're not getting more fiscal and structural policy, you wonder whether the benefits of negative rates are worth the cost.
Yeah, but I would also add that if you look at the chart with European money flows, that happened exactly when negative interest rates came, that people just completely lost confidence in European fixed income. So it's not just that European negative interest rates is sort of a little innocent thing and it hasn't really done much. It has changed the whole game of how people think about things, and that's why the flows of money out of European fixed income is happening at this enormous rate and is holding US rates down in a very significant way. A complicated way of saying that is that all Mickey Mouse models of 10-year rates in the US would basically say that US 10-year rates should be a lot higher than where they are. So if this is dragging down US rates, it suddenly means that US rates are down basically because European rates are so low. So if European inflation goes up, we could have a huge move up also in US rates. So in other words, the anchor on US rates coming from Europe is very substantial at the moment. So that's why, put differently, 50% of treasuries are held by foreigners and 50% are domestically. So that means that whatever happens abroad has actually become really important, including negative interest rates for US rates.
Okay, Peter Doyle?
Two questions, if I might. The comparison between Denmark and Switzerland is instructive in various ways, and I think people will see a difference. Niels was very confident that intervention would basically be sufficient to deal with the problem, whereas you saw in the case of Switzerland that it was not, and it blew the exchange rate regime out. What's the difference between the two? The difference between the two is the scale of the capital inflows being faced. Much smaller proportionally in Denmark, much bigger proportionally in Switzerland. So an obvious question to ask, therefore, of both cases, if there were to be a repeat of a surge of capital inflows, perhaps larger than you've seen in Denmark more recently, would the problems that you've seen in Switzerland, where there's concern about the political resistance to lowering interest rates, appear now in Denmark? Would some of those confidence effects that have not been apparent so far in Denmark appear simply because of the scale of the shock? And indeed, a follow-up question would be in the case of Switzerland, if there were to be another big shock, inflow, and people were presented with alternatives. If you're not going to lower nominal interest rates further, what would you do instead? Would that actually relax the political constraints when they're faced with the actual concrete alternative? That's my first question.
Okay, can we pause there first? That one. What if you had Swiss-size capital inflows or outflows?
What if, I mean, this is a hypothetical question. It's very difficult for me to answer. We are not Switzerland, and for obvious reasons. I will not go deeper into that because it's speculation.
You want to respond, Jean-Pierre? Peter, can we get, Brendan, can you bring the mic to Jean-Pierre?
let me answer partially, but I think it's a good question. There is a bit of a contradiction in my speech where I said I think we have to be very careful with the reaction of the public and then selling negative interest rate. And at the same time, I say in Switzerland we may have a way, right? But it comes exactly from your question. The answer to your question. Switzerland has more at stake in a sense with this zero lower bound. We absolutely need this negative interest rate differential. And if there was more shock, I would think this is one domain where we could potentially convince the people and the politicians that yes, we have to go lower in a partial way, the way that I have described. And yes, there would be possibility, I think, to change the mind of people.
Peter, can I defer your second question? Can you give the mic to this gentleman over here? I just want to get a few more people.
Good morning, Harry Rousseau, Power Corporation Canada. Could it be that commercial bank reaction to negative interest rate was also largely influenced by the fact that as central bank were introducing negative interest rates, European banks regulator were introducing Basel III concerning capital risk, liquidity risk, and operational risk. And in that context, on the liability side, the commercial banks were putting a lot of value to personal deposits, which was credit on the capital requirement side. And on the other side of the balance sheet, making more risky a loan was also big penalties. So in a sense, we have so many things happening at the same time, the left hand doing the other thing than the right hand was doing. I wonder if the experience was a real one.
Anybody want? Was regulatory policy and monetary policy at odds here?
I can talk about it in the U.S. context. I mean, I think it's generally true. And I think on a lot of adjustments to sort of the structure of the banks, more capital, more liquidity, so more cost, fewer assets and lower yielding assets to sort of spread that higher cost over. So in the U.S., one of the things we've seen from the U.S. data is, yes, indeed, the largest banks have tended to shift more of their deposits onto retail deposits, which have a lower cost, and we've seen sort of a pickup in commercial deposits, more expensive deposits, and sort of mid-tier institutions. So it's definitely the two of them are definitely sort of having compressing effects. It's not just the NIM; it's also what comes after the NIM.
NIM, net interest margin.
Net interest margin.
This is an acronym-free zone.
Ruchir Agrawal, IMF. Question for Torsten. You said that confidence went down, but wouldn't people move the funds to the U.S. even if confidence was the same just because rates were lower? So are you using the word confidence to imply simply level of rates?
So, yeah, that's a good question. But confidence, of course, means, but not only that the confidence among investors was declining, that this would be working or functioning, because if your job as a money manager is to try to generate a stable cash flow, and you're suddenly told that the bonds that you're investing in are now paying negative out to 8 years, the confidence effect is that you suddenly start to say, wow, we got to have a whole new look at our portfolio. So that's for the investors. The other confidence effect is for consumers, that if we turn, quote unquote, Japanese and say, gee, I have very little confidence in my future income. So maybe that's why the wealth effect has declined so much. And same thing for corporates, if the confidence effect that corporates say, well, why should we invest anytime soon? Because we just don't, this is a signal that the central bank is telling us that this is just not functioning, that this will take a long time. We were all hoping that negative interest rates will only be temporary. But these things have now been here for quite some time, and there's just a relatively.
But do you think that if interest rates were at 50 basis points, suddenly that this move to negative rates is nonlinear psychologically?
So for portfolio managers, I'm absolutely convinced that it is.
Yeah, well, I've already written them off.
Yes, that's true. That's true. But for, consumers and for corporates, then I think it would be much less convincing in that sense. I don't think that there will be the negative confidence effects as a result of that. We simply entered a new regime, and that new regime has some implications that people have changed their behavior. Right. So put schematically, the behavioral coefficients, if you will, in your whole purpose model just have a much lower coefficients. People are just much more risk averse.
Ma'am, did you have a quick question? Okay. This will be the last one. But
Hi, Maria Hayaka from BlackRock. I have a question specific to Denmark. Do you see any impact from the negative mortgage rates on the banking system through covered bonds and their use as collateral?
No, I don't see that. No.
Okay. I like yes no questions. All right. So. Carrie, can you go to the mic and tell people what happens next so I don't screw it up? I don't want to undermine confidence.
I've had enough of that.
We're going to break for lunch now, and we're going to reconvene at 1:45 back here. Please help yourself. There are sandwiches out in the hallway and beverages. We also have a cafeteria down on the other end if you want to find a place to sit with your lunch. We'll start back for our afternoon session at 1:45. In the meantime, we're going to try to broadcast Janet Yellen's speech in here. Thanks.
Hopefully with audio as well.